A broader look at the S&P 500 here, looking at what's happening with energy, leading those gains up more than 1%. If you look at more of what's happening with the decliners, though, the bottom four, real estate, utilities, staples, healthcare, those are all defensive-oriented type corners of the market. So it's more, especially when you're thinking about cyclical, not just energy, but materials also up about 1%, but then also industrials behind it, and then technology and discretionary just slightly higher there. So ending a holiday shortened week there, but the S&P 500 did head into this week down close to about a little under 1%. So depending on how things shake out today, it still will be a weekly decline, but it's been a huge streak of gains when you're looking at just not even the S&P 500, but the NASDAQ 100. Obviously, we've talked a lot about how that particular tech index has had the best first half of a year ever, even better than the first half in 1999. So sort of the question about whether or not that can continue there, but it would make sense.
Oh, and what happened after 1999?
Well, that's a whole...
I'm just asking.
Are you going to compare
now
to the dot-com bubble? You know, it's interesting you asked that, though. So I actually have a story running on Sunday that I'm working with Elena Popina about. So this is some data that Gina Martin-Adams and her team at Bloomberg Intelligence were crunching. So they looked at the extremes when you're specifically talking about the narrow concentration with tech shares. So specifically the
what
top
we call bad
stocks.
breath, right?
The bad breath, yeah. Well, I mean, they're saying something a little bit differently. They're arguing that typically when you've seen narrow breadth like that, that doesn't necessarily mean it's doomed for the stocks. Usually when you go back and you look at some narrow breadth like that, it actually historically has meant you've continued to see some stock gains, some pretty good hefty gains for the next 7 to 8 months. So it's not necessarily something that, I mean, obviously it would be hard to replicate close to a 40% gain again for the NASDAQ 100, but it doesn't necessarily, they're arguing, mean that it's over in that. But also they think this could be a situation where you see things broadening out. We especially saw that in June. So more cyclical corners of the market that are tied to the economy. If you're looking at the Russell 2000, obviously the small cap type stocks that had struggled, those had picked up, but then also looking at energy, materials, industrials, and particularly when you're thinking about transport. So when people think about Dow theory, what that means for the broader market, if you thought back a year ago, there was definitely a smoke signal there when transport started to break down, but those have held key support levels. And so when you're seeing that, the question is, well, can we continue to see that breadth? And the big test would be earnings season. So we're going to hear from the big banks at the end of next week. So July 14th, that's when we'll hear from JP Morgan and others. We'll also get updates from other companies beyond just banks. Delta will be one of them. We actually heard from them last week. They were already talking about how their outlook was kind of brightened just because of the summer travel season.
Right.
So they're thinking that could help. But then we've seen some of these airlines struggle in other ways. But overall, it seems like consumers are definitely out there still spending and traveling.
The banks are going to be interesting, though. It's just like the cost of deposits has gone up significantly, has it not?
Yeah, no, it has. Something in particular also that I've been looking at. So on Fridays, Michael Hartnett from Bank of America puts out his flow show notes. So this is when Bank of America does their own modeling on EPFR data. So that's flow data that comes out weekly, and it goes through the middle of the week on Wednesdays. But so what he's arguing is that he thinks even though tech shares have led these gains, he still thinks they're going to be harder hit there. So taking a look at some of these flows this week, it's interesting though. Equities in this latest week actually saw about 15 billions in inflows, and bonds had about 12 billion of additions as well. And U.S. stocks actually had their first inflow in about 3 weeks. So there's been this divergence, especially with growth shares. Lipper has some data on this. So even though we saw this huge run in the NASDAQ 100, at the same time, you saw outflows in growth stocks. So it's kind of a head scratcher. How could you see outflows at the same time? So when you think of more of a, if you had a pie chart and you're thinking what comprises the composition of the U.S. stock market, ETFs and mutual funds, which a lot of these flows track, they're a smaller portion of the pie. They're only about a little under 20%. It's about 18%. But when you think about hedge funds, institutions, insurers, pensions, retail investors, that's 70% of the market. So that's why a lot of times when we do get some of these flows data, it doesn't always square away with what you're seeing happening in the broader stock market.
Well, Jess, I'm so curious about this because I wonder when you talk about those large caps and growth stocks, is part of the outflow there people just sort of taking some cash
Actually, it is. So when I'm talking to portfolio managers, a lot of them had come into this year and they had actually added exposure to growth and tech names just because they had underperformed so much. Yeah. So it's not necessarily that they think it's sort of this doom and gloom scenario. They just had to recalibrate their funds. Some of them made it a little bit closer to value and growth. It depends also on who you're managing money for. So say if you had clients who were closer to retirement or retirees that still wanted to get some gains toward the stock market, they put them more geared toward value type areas as well. And then also bonds because it's a little bit safer for them. But obviously, if you have a longer term trajectory and you're younger, you could definitely take on more of that risk. So it depends on the portfolio manager and who they're managing money for. But definitely there's more of a recalibration there, but not necessarily due to bad things. More of like just lofty valuations, right? And then the question about the Fed and how much longer they go with these higher rates.
And that also, like, today's jobs data versus yesterday's. What are your sources telling you in terms of how they're thinking about it?
Well, also, like, the ADP report is obviously the private payrolls, so that doesn't always going to match up with what you're seeing with non-farm payrolls. So you did see it cool off a little bit on the headline number. The month over month, when you're looking at average hourly earnings, it also got revised the prior month, so both months were up about 0.4%. But overall, you're seeing that move in a better direction here, but we do get CPI next week on July 12th. So that'll be, it's not the Fed's preferred gauge, it's a PCE, but still CPI has been the one that tends to move markets, and it's more weighted toward, about a third of it's toward shelter and housing. So that's something that is why that's been a bit higher than when you're looking at PCE.
That would have to be a really big surprise to move the needle really on Fed expectations.
And also, I want to mention this report. So this will be the June data. A year ago, it was when CPI peaked at 9.1%, and now it's down around 4%. So to be cut basically in half since then kind of brings up the question about, you know, whether or not has Fed Chair Jerome Powell and the others been able to successfully do their job. So I think it's going to be tricky as far as how much further it can get down to 2%. But overall, those year-over-year numbers have come down pretty dramatically.
All right, Jess, any final thoughts for us before we move on to munis?
I mean, I figured y'all were talking about Levi's and Rivian, but Rivian this week, I mean, it continues to get this slate of good news. It did jump. This Wedbush actually lifted its price target, so it's up about 11%, but this week alone, it's up about 40%. So that's a stock that I'm keeping an eye on, RIVN.
There you go. Rivian, it always is until it isn't.
It is.
Right?
That's true.
You know what I mean? So that's what you can count on Rivian for. Jess Metten, thank you so much for joining us. I know you're very busy covering all the most important news that we cover here at Bloomberg when it comes to equities. So really appreciate you coming in studio for us here. That was Jess Metten. Having said that, we are going to get to an incredibly exciting, interesting segment here. We have got to get to our Muni Moments segment, and our focus on munis, I should mention, is brought to you by Build America Mutual. The New Deal created American infrastructure that unleashed new opportunity, and today we're doing it again with massive investment in modernizing our infrastructure and municipal bonds backed by Build America Mutual. Make it happen. Invest in the future of America with insured bonds. Nice.
They all sit together in Princeton, you know, because I see Ira Jersey in the background. It's like, that's one exciting section.
That's
down
an
there in
exciting section. I agree. And we're going to go over there right now. We've got Eric Kazatsky with us. He is a senior municipal strategist for our very own Bloomberg Intelligence, joining us from Princeton, as John said. Eric, thanks for being with us on this Friday. What are you looking at when it comes to munis this week?
You know what? It's a rate story, and I have no one better than the rates king himself sitting right behind me, Ira Jersey, right? Look, you know, what we're focusing on is just the relative value opportunity, or really lack thereof, in most of the muni curve right now. You know, ratios are getting richer. That means muni prices are going up, and it's something that we expected coming into this year. But you know, the Fed jawboning about more hikes coming is certainly not helping matters in our space.
What's a muni giving me these days? What's the rate?
Well, what part of the curve do you want to look in? We can talk about that. You know, if you're looking like far out the curve, you're getting a 356, but we think that's still a little rich. We think that could probably cheapen up another 10, 15 basis points. And that's on an exempt basis, right? Depending on your tax bracket, you know, you whack that up, you could be looking at over 6%.
That's 6%. Pretty much guaranteed. The defaults aren't a thing anymore, are they?
No, very, 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 very low.
But still,
even as we're seeing credit weaken.
I was going to say, we're seeing delinquencies on the rise when it comes to loans, particularly in the auto space.
Yeah. I mean, what we're seeing right now in the municipal space is just a slowdown in taxes, especially on the state and local level. But as we saw during the great financial crisis, that really is something that takes like a few fiscal cycles to really play out. Nothing fast ever happens in the municipal space, which is a good and a bad thing, right?
What does supply look like right now?
Extremely low, and that's part of the reason that we're seeing an upward pressure on pricing. Year to date, primary supply in our market is off close to 20%. It's even worse when you look at taxable munis, you're off about 50%. But given the rate environment, it makes a lot of sense, right? A lot of issuers are looking at where rates are and thinking that they can just wait for a better day to come. Unfortunately, I don't know if that better day is going to come, at least for the duration of 23, for them to jump back in the market and time it.
Well, square that with Bidenomics and the push for infrastructure spending. Square that for me. I don't understand.
Yeah, I mean, look, there's an actual push from the federal government to subsidize a lot of projects and spending, but at the end of the day, it's really at the sole discretion of these local issuers how they want to dole out that money. And, there's really no time clock clicking for them. So they have the luxury of time on their side to wait a little bit and just see if rates ease.
Okay, so talk to me about AAA here. You've got this story you sent us. AAA exempt, no longer world-beating yield monsters of yesteryear.
Yeah, exactly. So look, for the better part of the last few years, when you looked at the tax equivalent AAA yield, they were better than obviously U.S. Treasuries. But if you look across the landscape of other sovereign yielding, they were better by a multitude of 50 to 100 basis points. That's really not the case anymore with the shoot up in U.S. Treasury rates, especially in the front end of the curve. So what we were trying to point out is that things are just getting a lot richer. And if you're buying munis 10 years and in, you're almost better off just buying a T-bill.
Do you have a favorite issue? I mean, just like the project and that sort of thing?
Yeah.
I mean, my favorite project right now is the American Dreams Mall over in New Jersey.
Of course it is.
It's a source of never-ending excitement, and just following the.
Have you been there?
Space, I have not. I read a lot about it. It would really have to be something totally exciting to get me in the car and drive all the way up to the Meadowlands to go shopping.
Yeah, and brave all that traffic. Now, just for people who aren't aware of this is a mall that, I don't know, how many billions did this cost?
So expensive.
All sorts of problems. Right. They now have a gigantic Ferris wheel, so you can get to the top of the Ferris wheel and look out over a swamp.
Wow, I mean, you're selling me on this right now.
And
so maybe I'll switch up my weekend.
I
think they have a ski slope, an indoor ski slope, as well as the aqua park.
It's so funny. You're literally describing the Dubai Mall, which was the only activity that I had to do when I was living there for a couple of months because not much going on there. But Eric, why all the investment in this mall when we know that
Eric,
people don't go
you want to handle
anymore?
that one in 30 seconds?
Well, all the investment in that mall because it was generating a lot of money from a project standpoint. And you had buyers who were extremely interested in buying entire deals in the high yield space. So there was readily available financing to build that. They didn't see the pandemic coming, and that's caused a lot of hiccups for the mall. And that's what you're seeing the shakeout right now.
A classic didn't see
They're
the
not going to
pandemic
default,
coming.
though, or are they? Or what's the...
Well, they're already defaulting in various stages. So slow-moving train wreck.
Too late. I hate when that happens. All right, Eric, thank you so much for joining us. We really appreciate it. Thanks for making bonds
I've never
fun.
seen the Ferris wheel actually operating when I go by on the New Jersey
That's
Turnpike.
the same thing with Dubai. The Ferris wheel doesn't work because they made it too big. So it's like it really exists for no reason, which I think is the same. I'm not sure, but I think that's the same thing going on in Jersey. I think that it doesn't actually function. So, John, we're going to have to go elsewhere for our Ferris wheel needs, etc. All right, guys. Thank you so much, Eric Kazatsky, for joining us on this week's Munis Moment. We really appreciate it. Giving you a quick look at what's going on with markets here. Again, not a ton to report, guys. S&P pretty much unched there. NASDAQ up by about 0.2%. This is Bloomberg. Let's get some company news now with Bloomberg's Steve Rappaport.
Maddie, it's bye-bye for Bye Bye Baby. More on that from Bloomberg's Dan Schwartzman.
Steve, Bye Bye Baby stores will close after it failed to attract adequate going concern bids in a bankruptcy auction. New Jersey-based baby goods company Dream On Me Industries won an auction for Bye Bye Baby's intellectual property last month, but advisors kept searching for a buyer for the whole business. The unsuccessful sale caps a tumultuous period for the brand and parent company Bed Bath & Beyond, which is also shutting down. Bye Bye Baby was a key part of last-ditch efforts to keep Bed Bath & Beyond out of bankruptcy. Steve?
Thanks, Dan. Tesla starts to lay off some battery workers at a plant in China. Bloomberg's Ed Ludlow reports.
There are 20,000 people that work in that Shanghai plant. What we're talking about is individuals on the team that take the cells from third-party suppliers and assemble them into modules and packs. One source told us that an element of this is because there is an aspect of automation that can replace some of those jobs. But this comes at a time where we are talking quite a lot about the price war, quote unquote, in China.
Thanks, Ed. Earlier this week, Tesla and more than a dozen Chinese EV makers entered a pact to maintain fair competition and avoid abnormal pricing. Shares of Tesla are now up more than 0.25%. And former hedge fund manager Crispin Odey faces more allegations of sexual assault and harassment. 6 additional women came forward after the Financial Times published accounts of 13 women who said Odey abused them. He was forced out of his company when those allegations surfaced. And those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow lower, the S&P, NASDAQ. They are both advancing. Stocks are slipping after hiring data this morning did remain high enough to quash speculation that the Federal Reserve will leave rates unchanged later this month. We've got the 2-year 4.90% with the 10-year yielding 4.02%. S&P little change, choppy trading this morning. S&P up 2 points right now, up less than 0.1%. The Dow down 48, drop there of 0.1%, while NASDAQ is up 42. That is a gain of 0.3%. The Russell 2000, though, outperforming, up 28 points, a gain right now of 1.5%. Spot gold at $19.29 the ounce. It is advancing $18, up by 1%, while West Texas Intermediate crude is up 1.1%, $72.63 a barrel on WTI. So again, recapping here, we're looking at a mixed Friday here with the S&P up 2 points, little change. The Dow lower by 0.1%, NASDAQ up 0.3. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right. Thank you so much, Charlie. Really appreciate it. I am very excited to get our next guest, Mandeep Singh, on. He is, of course, the senior tech analyst with Bloomberg Intelligence. Mandeep, do you want to hear something really embarrassing? I really thought that you were sitting at your desk because in the monitor, you're kind of small. And so I was like, why didn't you come into the studio? You really don't want to sit in a room with me?
I think he's over there. It's just like I can see him.
He's got a Zoom background that looks identical to the office. So that's, sorry to blow up your spot here, Mandeep.
It's a fake. Nice.
It's fake. That's what I'm saying. It's fake. Anyway, so yeah, Mandeep, nicely done on looking like you're in the office. Having said that, let's get to some of the big news going on in the tech space today. What are you looking at when it comes to Meta's Twitter clone here? John and I were just talking about it. It's doing pretty well, yeah?
Well, 50 million. And you know whose record it's set to break? ChatGPT's, because it took ChatGPT almost 2 months to get to 100 million monthly active users. Guess what? At this pace, this thing can surpass that easily. And not surprised, given, you know, how well the rollout was, and you know, just the seamless nature of transferring Instagram users to this new app. So nicely done, Meta.
Okay, did they rip off Twitter? I mean, there's the accusation that they used some of Twitter's former employees, engineers, et cetera, blah, blah, blah.
I have no idea if that is true. I think they denied that. And look, when it comes to social media and web in general, I mean, the features are a commodity, right? At the end of the day, if Google notices something cool in ChatGPT, they're going to replicate it and bring it into their search page. And that's just how, you know, these products evolve. They do copy features. Facebook has notoriously copied, you know, Snapchat stories features and brought it to their, they did that with TikTok, you know, the whole Reels product came after TikTok. So I think it's hard to argue that, you know, they copied Twitter's layout, and maybe on the talent side, there could be something around it, but it's very hard.
All right, how are you going to make money on this? I mean, they're not doing ads, right? Or at least not now.
They're not, but it's too early to focus on monetization. Look, for Meta, they know they are very good when it comes to layering ads within their feed. So I don't think anyone doubts the fact that they'll be able to monetize it. To me, the most important thing is the engagement. Yes, they have the signups now. How do they make sure the engagement continues to grow? And for that, you know, the Twitter interest graph, I mean, think of creators, right? They have a certain number of followers on Twitter. How do you bring that on threads? And I think that will be the challenging part. The other part of it is algorithm. How do you curate that feed? Because that has been the frustration for Twitter users, is the feed just constantly keeps changing for the worse. I mean, I see a lot of unrelated things that I don't want to see, and I have to mute it and block it, and it's just not a good experience.
But people have said the same thing about Instagram, which is where Meta launched Threads from. So I'm curious what you think Meta is going to do to hedge against those same concerns.
Yeah, so that's where, you know, algorithm is your secret sauce. I mean, that's why TikTok did so well, even though they didn't have the user graph, is because they got the algorithm right. But I would bet on Meta, given, you know, all the investments they have done on large language models and really trying to take a lead on the AI front, then Twitter, which has obviously struggled, you know, with products and ads. So clearly, I think Meta has the resources. They have the family of apps. I mean, think of the 3 billion users they have across the family of apps. And Meta isn't going to grow by adding more users. They already have that. They're going to grow by engagement, which is why, I mean, think of the difference in Meta's revenue versus Google's revenue. Google also has a similar base of around 3 billion users across their family of apps. The difference is Google has more apps that have over 1 billion daily active users, and that's why they generate more ad revenue. So that's what Meta needs. They need to keep adding things where they can add engagement.
Well, also, I want to go back to something you said earlier about Meta finding a lot of success historically with copycat moves. I wonder, given that this is coming as Twitter has restricted our tweets to about, 600 a day for unpaid users. I hit that limit literally every single day. Could we see Twitter and Elon Musk saying, okay, we've messed this up. We need to roll back some of the changes we've made, stop charging people for some of the products that they had gotten used to having for free? Or is that a pipe dream for me?
No, I think that's very likely going to happen. And look, I know the reason why they implemented this to begin with, which was really to prevent these kind of large language models or algorithms from scraping data. So that's the problem they were trying to solve for. I think there are better ways to solve for that problem instead of restricting users' access and limiting the number of tweets they can see. Yeah. And that's where, these companies have to constantly find solutions, whether it comes to dealing with bots or misinformation on the platform. And I think Twitter probably is under investing in R&D right now, I would argue.
Let me ask you about ChatGPT, the users there. Is that some sort of bellwether maybe for artificial intelligence and companies like NVIDIA?
Great question.
Yeah, so clearly, I mentioned 100 million users in 2 months. That was a record. And look, there is interest, but I still think the way this is going to evolve is every company will see the existing platforms, whether it's Google or Meta or anyone else, Snapchat, they're going to see what is resonating with users about ChatGPT. And they're going to try and bring those features on their own platforms. So it's not as if whatever ChatGPT has done cannot be replicated. I mean, I really think from a UI perspective, these companies are constantly going to make changes, iterate on their platforms, and they're going to try and bring those features. So yes, you are going to see ChatGPT functionality expand, but I don't think you're going to see ChatGPT be the only one to offer those kind of features.
Okay, so ChatGPT, can I safely say that's not necessarily the face of artificial intelligence?
Yes, that is the correct way to frame it.
Okay.
But maybe
It's the first correct thing I've gotten this week.
Well, I wouldn't say it was a correction. I think the
correct first, whatever.
The first thing you got correct this week. John, everything you say is correct and perfect in every single way. Mandeep, though, on that point, is it more about the LLM then for ChatGPT, and to what extent can other companies kind of copy paste that in a way that's going to be quick enough for users to be happy about it? Like, listen, I don't want to log into ChatGPT every day when I want to use it. I would happily do that on my Instagram app if I could, but that's not an option for me right now.
Yes, so that's where I would say the number of companies that can replicate it are somewhat restricted now, in the sense that, yes, the large platforms have their own proprietary data, but if you are a startup looking to build something similar to ChatGPT, you'll have a hard time, because every company has become conscious of their data being used for a large language model, which is the problem that Twitter is trying to address here by limiting the number of tweets. And that's where, if you're a startup thinking of developing a large language model based on open internet data, forget it. I mean, everyone is restricting access to their data. So I think the open internet data is going to shrink. And that's one of the things that we are observing more and more, because this is a competitive. Everyone wants to make sure they have the best proprietary data, and they don't want to give it away.
On this Friday afternoon, approaching the weekend, what has got you really excited? What are you looking at? What are you going to do this weekend?
I mean, Threads, I'm looking at when they're going to cross 100 million. At this pace, they could maybe do it this weekend.
So Threads could beat ChatGPT this weekend in terms of initial user signups. Is that the stat?
Yes.
Will they get to Twitter levels? I mean,
look, they're still not in Europe, so that's one of the factors you have to consider. They are, missing out that launch in one of the key markets, but still, it's been remarkable. First 3 days, I mean, the pace, this has gone viral.
Yeah, I mean, I finally gave in last night and downloaded it because I have to.
Lock the handle.
And also, I have to do it, but I'm really annoyed that I have to be on another social media platform. What a challenge for me. What a hard life. All right, Mandeep Singh from Bloomberg Intelligence, thank you so much, as always, for joining us. That was Mandeep Singh, our senior tech analyst with Bloomberg Intelligence, joining us to talk ChatGPT and Threads. This is Bloomberg. Now we're going to head to D.C., get some world and national news with Nathan Hager.
Madison Treasury Secretary Janet Yellen says competition with China should not be winner take all. Yellen met today with China's Premier Li Qiang after encouraging U.S. business leaders in Beijing to diversify rather than decouple. More from Bloomberg's Jill Desis in Hong Kong.
That idea of diversifying economies is a bit softer than de-risking, which is something that we've been hearing out of the U.S. and Europe this year, and is obviously that was even softer than the decoupling language that we've heard. So I think that just kind of reflects how difficult it is for these economies and how they have to kind of tailor each of their responses to whatever the other country is trying to do in terms of limiting trade.
Bloomberg's Jill Desis there from Hong Kong. Back here in Washington, House Republicans are demanding more information from the Secret Service about the cocaine found in the West Wing last weekend. House Oversight Chair James Comer sent a letter today to Secret Service Director Kimberly Cheadle asking for a staff-wide briefing, saying the discovery is a shameful moment in White House history. The White House says President Biden is determined to get to the bottom of it. This week has brought the rapid pace of climate change into sharp focus. We get more on that from Bloomberg's Amy Morris in Washington.
We already saw record heat on Monday and again on Tuesday as global temperatures soared well above anything recorded before. And then on Thursday, data from the National Centers for Environmental Prediction showed that it got even hotter. The effects of climate change are being exacerbated by the arrival of the first El Nino in nearly 4 years. A report from the UN says global greenhouse gas emissions need to be cut to 60% below 2019 levels by 2035. In Washington, I'm Amy Morris, Bloomberg Radio.
And one more data point, the head of U.S. Border Patrol says more than 100 migrants have died in the heat along the U.S.-Mexico border so far this year, including 13 this past week. Global news, powered by more than 2,700 journalists and analysts in over 120 countries. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
On Wall Street, stocks continue to trade mixed. We have got the S&P higher, NASDAQ as well. The outperformer, the Russell 2000, we begin there. That is up 1.6%, but the Dow lower by 40 points now, down by about 0.1%. Hiring data did remain high enough to quash speculation that the Federal Reserve will leave rates unchanged later this month. Reaction to the jobs report from PIMCO economist Tiffany Wilding.
I think today's labor market report did show that the economy is slowing. The labor market, is slowing, but nevertheless, it's still really strong. And ahead of past recessions that we've had in this country, labor markets tend to be relatively strong until they're not.
And you can hear more of that conversation on the Bloomberg Surveillance podcast. You can download it wherever you get your podcast. 10-year yield right now, 4.02%. We've got the 2-year yielding, 4.91%. Spot gold up $19 the ounce now to $19.29, a gain of just about 1%. West Texas Intermediate crude oil up 1.7%, $73.01 a barrel. And Bitcoin up 0.1%, 30,347 on Bitcoin. Bottom line here, we are looking at a mixed market with the Dow lower by 43 points, down 0.1%, while the S&P is trading higher now by about 0.1%. Tesla shares up 0.5%. Sources tell Bloomberg Tesla is laying off some battery production workers at its Shanghai plant amid a bruising price war in China that has seen manufacturers across the board heavily discount cars. Recapping the 10-year yield, 4.0%, with a 2-year, 4.91%. Mixed markets on this Friday. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right. Thank you so much, Charlie, as always. Just want to run through some headlines we're getting because Chicago Fed President Austin Goolsbee is speaking on CNBC right now. He said that the job market... Oh, what?
Never heard of it.
Another network, just a different network. But, still got to read out some of these big heads that we're getting from his Fed speak there. Stop laughing at me, John. He says in a shocking twist, the U.S. inflation rate is still too high. Having said that, he does say, look, it's clear the job market's strong, but it is cooling off. And he continues to be bullish on the idea of a soft landing, saying we can get down inflation without necessarily pushing us into a recession. He says that he feels like we are on a golden path ahead, John.
You ever feel like you just want to tell the members of the Federal Reserve Board to just shut up? Speak with one voice.
That way. No.
It never would have happened with Paul Volcker. He such a tight rein over other members. It's like, you're going to do what I tell you to do, basically.
Well, it is funny to see kind of like the infighting play out when
Alan Greenspan, I should say, but yeah,
You're not enjoying seeing them fight?
No, I don't. I think it adds to
most professional way.
I think it adds to I'm all about disclosure, that sort of thing, but I think this just adds to a mishmash and confuses everybody.
Yeah.
Too much.
Fair enough. I'm in it for the plot. I just think it's kind of funny to hear them all fighting by saying things like we're on a golden path, which are considered fighting words to other Fed members. Having said that, I know you're all loving our Fed Speak analysis here, but we've got a great guest in to talk with us about the jobs data and how it's going to impact Fed moves moving forward. We've got Julia Pollack here. She is a chief economist at ZipRecruiter, joining us on Zoom to talk through some of these jobs numbers. Julia, thank you so much for coming on this morning with us. Talk to me about what your take is on the current jobs market. I mean, if we're listening to Goolsbee, it sounds like it's strong but cooling. Would you agree with that description?
Absolutely. Strong, solid, robust, but there are clear signs of cooling in today's jobs report, not just the slowest job growth number since December 2020, but also a rise in the number of people working part-time for economic reasons. Those are people who've had their hours cut or who can't find full-time work but want to be working full-time.
You guys, ZipRecruiter must generate its own proprietary data. What does that tell you, if anything?
Absolutely. So that has shown a larger decline in online job postings than even in BLS reported jobs data, but a rebound in June. So we also saw a pretty strong June. but even clearer signs that the labor market is cooling down and that the Fed's interest rate hikes are starting to bite, that they are reducing private investment and causing companies, even those that would like to be hiring more, to be a bit more cautious and concerned.
What about wages? What does your data show?
So wage growth in job postings has also slowed. In 2022, the share of job titles that saw average wage increases over the year was 3 times higher than the share that saw declines. This time around, we're actually seeing more job titles show lower average posted wages in job postings than gains.
Yeah, it's so important to watch, and our Bloomberg economics team puts it really well that they still anticipate a recession coming in the second half of 2023, so anytime now. And they say that you start to see those cracks in the labor market about 2 to 3 quarters after a recession officially begins. So Julia, I wonder if when you're looking at the data, does it feel to you like this is just the beginning of the tidal wave of recessionary impacts on the jobs market, or is it something less intense than that?
Well, I think it's something less intense than that. I think we're now at a place where the labor market is at a sort of steady, sustainable pace. We could keep this up for months and months and months. Employment levels are still well below their pre-pandemic trend. And so there's still a lot of catch-up hiring that could take place in the coming months. Industries that were hardest hit in the recession are sort of finally playing catch-up, like the government, not an industry, but you know what I mean, a sector that was far behind. So I think there are lots of reasons to be bullish on this labor market still. And then we also just had a almost 15% return in the stock market year to date, and a rebound in consumer confidence. All of those things could bode well for job growth in the future. There are huge risks, don't get me wrong, but I don't think we necessarily are in a bad place.
I put this question to just about every guest we had today. I'll put it to you. Who's in the driver's seat? Did the employers have the leverage or the employees?
It very much depends on the industry you're talking about. Goods-related industries like retail, transportation, and warehousing, workers there have seen a large decline in their leverage, and that's because consumers are shifting their spending back from goods to services. Tech is still a glaring weak spot in this economy, with far fewer quits than before the pandemic and more layoffs than before the pandemic.
Can I talk to you a little bit about your new hire survey that you include in your note here? I love talking about employees ghosting their employers. Do you know about this, John?
I do it all the time.
There's an increase, I'm sure you do, increase in employees ghosting potential employers after getting job offers. Julia, what do you make of that, and how widespread is this starting to get?
So in this survey of 2,000 recently hired Americans, I mean, there's still plenty of sign that workers are confident and that they have a lot to leverage. So much so that they don't need to behave well necessarily. They are, yes, exactly. They're still getting pretty big wage increases. They're still getting attractive offers, and they're still finding jobs very quickly. And the other thing that they're seeing is that companies have made huge improvements in their recruiting and hiring processes since the pandemic. They have made those far more mobile friendly. They've also adopted more automated tools. That's the likely explanation for the increase in the share of workers who are getting very quick responses to their applications. I think many companies have automated that system and tell people right away whether they're likely to get a job.
Real quick, can they still work from home, or is that changing?
Work from home has stabilized at around 28% of all worked days in America, up from 5% before the pandemic. There are industries where you are seeing a bit of a pullback now, but on the whole, it's still very, very steady.
Yeah, and really quickly, I just want to mention, because we have to leave it there, job seekers look like in your survey, they're becoming more pessimistic across the board about current labor market conditions and the medium-term economic outlook, which is certainly something that I feel myself and amongst my friends here. Julia Pollack, thank you so much for joining us. That was a great conversation.
You're pessimistic.
Oh my God, of course I am. You always got to be worried. We work in media, John. We're never safe. Julia Pollack is the chief economist at ZipRecruiter. Thank you so much much for joining us. We're going to continue to cover the markets for you here and all the Fed speak, with Goolsbee saying the Fed is on the path to curb inflation. This is Bloomberg. Let's get some company news with Bloomberg's Steve Rappaport.
Twitter puts Meta on notice of possible legal action over the launch of its new Threads app. Bloomberg's Abigail Doolittle reports.
Alex Spiro, Twitter's lawyer, known as being super aggressive, basically said that Meta has hired dozens of former Twitter employees who may have access to confidential information. They're threatening that trade secrets lawsuit, saying that they will strictly enforce its intellectual property rights. It's highly confidential information. It's very difficult for this sort of a plaintiff to succeed. Ultimately, they may actually be looking for an injunction, which would also be difficult.
Thanks, Abigail. A Meta spokesperson says there are no former Twitter employees on Thread's engineering team. And in a reply to a tweet about a potential lawsuit, Elon Musk wrote, "Competition is fine, cheating is not." Japanese pharmaceutical company Eisai has won full FDA approval for a breakthrough drug to treat Alzheimer's disease. Leqembi doesn't cure Alzheimer's, but it's the first drug to slow the progression of a disease that affects roughly 6 million Americans. The FDA's blessing comes with catches, though: required testing for side effects and a warning label about the dangers of those side effects. Eisai shares closed 4.7% lower in Tokyo. And if you missed that spirited discussion a little while ago, career coaches have a new stream of revenue brought on by the COVID-19 pandemic. Some are charging as much as $3,000 to help people find remote-only jobs. Many companies, as we've seen, have scaled back or eliminated work-from-home policies altogether. But data from LinkedIn shows job advertising full-time remote work attracted half of all applicants on the platform in the month of May. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, everyone. Happy Friday. I'm Madison Mills here with John Tucker in for Paul Sweeney. Just doing a quick look at the markets here. Again, not a lot of volume going on today. The NASDAQ, however, up by 0.3% right now. The biggest gainer when it comes to equities, S&P up by barely, basically unchanged, and the Dow still staying in the red, down by about 0.2%. We're going to continue to cover markets for you here, but first we're going to check on some world and national news with Nathan Hager.
Madison, this is Bidenomics at work. It's President Biden's reaction to the June payrolls report. It did come in a bit weaker than economists expected, but still above 200,000 jobs added on the top line. Acting Labor Secretary Julie Su is highlighting the 3.6% unemployment rate.
Many predictions were that it would not get below 4% right after the pandemic-induced economic crisis for a long time, and these policies have defied that. And in fact, we've seen less than 4% unemployment for 17 consecutive months now, which is the longest duration since the 1960s.
Acting Labor Secretary Julie Su joined us earlier on Bloomberg Radio and Television. We're going to get more from Secretary Su this afternoon on Bloomberg Sound On. That starts in a little more than an hour, 1 p.m. Wall Street time, right here on Bloomberg Radio. Ukrainian President Volodymyr Zelensky is continuing his diplomatic push ahead of next week's NATO Leaders Summit in Lithuania. Zelensky met today with the Czech Prime Minister. He's sitting down with Turkey's president as well. Ukraine's Finance Minister Sergei Barchenko says Kiev is confident they will find a path into NATO.
86% of Ukraine citizens are eager to be part of NATO. It's our choice. Also, President Zelensky mentions that we expect our alliance will invite Ukraine to join.
Finance Minister Marchenko spoke earlier on Bloomberg Television. NATO Secretary General Jens Stoltenberg says next week's Leaders Summit will include a major support package for Ukraine, but no membership yet. A cargo ship fire that has already claimed 2 New Jersey firefighters' lives is burning for a third day. Tom Wilker is president of Gallagher Marine Systems, which represents the Italian-flagged Grande Costa d'Avorio.
Currently, the vessel is stable with a list to starboard side. We're continuing to monitor the status of the vessel, and actions are planned to mitigate further listing as necessary.
The Port Authority says multiple fires are burning on the ship's upper deck, so they could keep burning for several more days. Global news, 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager in Washington. This is Bloomberg. Madison and John.
Thank you so much, Nathan Hager. We appreciate it. Guys, we're going to talk about a really important story here that I love. This is from Justin Fox. He's a Bloomberg opinion columnist. Young men are gaming more. The question is, does that mean they're working less? The pandemic accelerating gaming time for young men. Guess what the average hourly or daily hours spent is?
Where they sit in front of a computer screen and do video games.
Yeah.
It scares me to even
Well,
think
we're up to 2 hours.
Really?
Yeah, we're up to 2 hours. But having said that, it's increased across the board John,
They're not doing are
Here's
they
the
doing
thing.
this at work or somewhere else?
well, this is the question of the story, which is the ability to play video games more often because the 20 to 24-year age group of young men is lagging behind both teenagers and prime-age workers when it comes to job market recovery. You haven't been a teenage girl if you haven't had to sit and watch a man play video games, John. So
You're
this
right.
is
I have not been a
This is an
teenage
experience
girl.
you haven't been personally impacted by, I imagine.
The amazing thing in this story, he cites the Bureau of Labor Statistics annual American Time Use Survey.
Yeah.
I didn't know there was such a thing.
Oh, there is. No, this was really interesting actually during the pandemic to look at because just obviously increased time like on TV and on your phones, complete plummet in people going out. But yeah, looks like the return of video game playing is still beating out even TV watching amongst this age group.
Really freaky, I know this is true, but watching other people play video games, that's also a thing.
All right, John. Thank you so much for that shout out. We're going to continue to cover markets for you right here on Bloomberg Radio. Madison Mills and John Tucker. More markets coverage starts right now. Cool.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe the central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
Happy Friday, everyone. I'm Madison Mills here in studio with John Tucker in for Paul Sweeney.
Happy Friday.
Happy Friday, y'all. Looking at the stock market, we are finally starting to see some conviction-ish, if I can say that, when it comes to the trade. Looking at the NASDAQ, up now by about 0.4%. That is the biggest green move that we've seen today off of that conflicting jobs data that the market's still trying to digest here. The S&P up by about 0.1%, and the Dow still in the red. We're going to continue to cover markets for you right here, but first I got to get a check on the news with the one and only Charlie Pellet.
All right, I thank you very much, and here's what's going on. Best level of the day right now on the S&P 500 index, as you pointed out, up 7 points to 44.18, up by roughly 0.2%. The Dow, though, stuck in the red, remains lower by 39 points, drop there of 0.1%. NASDAQ up 61 now, that is a gain of just about 0.1%, while the NASDAQ 100 index higher by 0.3%, but the outperformer today, small cap shares with the Russell 2000 up now by 1.5%. Stocks do remain mixed after hiring data remained high enough to quash speculation that the Federal Reserve will leave interest rates unchanged later on this month. And interviewed right here on Bloomberg Markets, Tom Gimbel, the CEO and founder of the LaSalle Network, a hiring firm, put today's jobs report like this.
Right. So we missed the number by a smidge. We still had over 200,000 jobs. The Fed won't raise interest rate. The party continues. Everybody's happy. But let's paint it as really sad and depressing right now.
And you can hear more of that conversation on the Bloomberg Tapes podcast. You can download it wherever you get your podcasts. 10-year yield, 4.03%. We've got the 2-year at 4.92%. Spot gold up $17 the ounce to $19.28, a gain of 0.9%. Bitcoin up now by 0.3%, 30,407 on Bitcoin. And West Texas Intermediate crude oil up 1.6%. WTI right now, $72.95 a barrel. Bottom line here, U.S. stocks, they are trading mixed with the S&P up 7, up by about 0.2%. Briefly, Starbucks violated federal labor law when it shut down a unionized store in Ithaca, New York. This according to a labor board judge. He ruled that the shutdown of a store near Cornell University's campus was, quote, done in large part to discourage unionization efforts in Ithaca and elsewhere. Starbucks, little changed right now, up by less than 0.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, thank you so much for that, Charlie. We are going to get to some stocks on the move with our Bloomberg Equities reporter in our Bloomberg Interactive Brokers studio with us, Carmen Reinecke. Carmen, thank you so much for coming back with us. We've been talking about how we're starting to see a little bit more movement when it comes to the trade today, but which names are sticking out most to you right now?
Yeah, so a big one still today is Levi Strauss, ticker LEVI. It's down a little bit more than 6% after its earnings report. It cut its full year adjusted earnings per share estimate and specifically flagged that the U.S. wholesale business weighed on the quarter and sort of led to that lower outlook. So analysts were, looking at that, not super happy. The other thing that we've seen, really outperforming today is Rivian, the EV maker. So it's up, I think, 12% because Wedbush analyst Dan Ives raised his price target to 30 from 25. So he also maintained his outperform rating. Basically, he's just saying that the car maker is making a major turn towards executing on long-term business models, and he cited that there's demand for its unique lineup of cars and that it's getting its production and supply chain issues under control. And this is interesting also because we saw such an incredible week for EV stocks. Tesla was also up on a delivery record, and that's lifted shares of other EV makers as well. The other one we were just talking about is Kura Sushi, ticker KRUS. And this is a really interesting company.
I like the description on the Bloomberg.
Exactly.
The company prepares various types of seafood products such as sweet shrimp, octopus, squid, salmon, tuna, snow crab, conch toro, and other related dishes.
It's better when you read it, John, obviously, with that voice.
No,
exactly. And it just, we all like sushi, but, what a company to, sort of be looking at. It's up today more than 10% because it had pretty solid earnings. It beat on adjusted EBITDA, and it also has had a bunch of analysts, praise it and sort of raise their price targets.
Wait, could this PE be right on the Bloomberg? 2,361?
Yeah, that's one of the highest ones I've seen. That's for sure.
That's right. Yeah.
Maybe a little over.
Well, okay, but this is, can I ask you this, Carmen? Is this in any way related to Kava obviously having a great couple of weeks following their IPO? We saw Sweetgreen beating out estimates with their earnings. It seems like perhaps, in the Sweetgreen call at least, they talked about the return to work being a boon for them. Is Kura Sushi moving on some of that news by any chance?
That's a great question. I'm not sure if Kura Sushi is so related to the return to office, but you're totally right. Kava's had a great IPO. I think its shares have doubled since it went, public, and Sweetgreen as well was lifted yesterday, and specifically the analyst that, raised its price target said, it's looking really good in the return to office crowd. Kura Sushi, though, also has had a really great year. Its shares have doubled. It's up more than 100%. So, clearly there's something to be said about, this trend in seafood.
I know.
What's Toro? I don't
Toro?
You
don't know what Toro is?
I have no idea.
That's because you're spending your time at the incredibly exciting fair in
right, in my
Jersey.
hometown. I was talking about that. They sell
sushi.
funnel cakes. They don't sell sushi.
I love a funnel cake.
Fireman's Fair there.
It's probably also doing well. Who doesn't like a funnel cake?
Exactly. Carmen, thank you so much for coming in to talk with us about some of the big moves today and for sticking with us throughout the morning. We really appreciate it. That was Carmen Reinecke. She is on our equities team here at Bloomberg, covering all of the most important stories for us when it comes to moves in the equities market. Having said that, we are going to get back to some of that jobs data from today. And on the line, we've got a really fantastic voice on this. We've got Jeffrey Cleveland here to discuss the jobs numbers and also what we're seeing in terms of moves from the bond market off of that news as well. Jeffrey, thank you so much for joining us to talk about what we're seeing here in the market. When you look at this June jobs report, it feels like some good news this morning if you're the Fed, bad news yesterday when it came to that eye-popping ADP number. Talk to me about where you think our economy sits when you're looking at the totality of that jobs data.
Well, I think the context matters, when you look at each report that comes out every month. And I talk to a lot of economic bears. They're my favorite species of market participants. And, they were telling me last month, hey, you have to look at the household survey. It was negative. You have to look at hours worked. It had ticked down. And, so lo and behold, we had, I think, a decent non-farm payroll number, 209,000. We had the household survey component of that bouncing back. So that was up 273,000. Hours worked ticked up. And then average hourly earnings, another 0.4 month-to-month print. So I think you have to look at that full context, and it's a pretty solid report in my view. It doesn't tell us, maybe the job growth is slowing a bit, but nothing close to a recession. And I even hesitate to call slowing. We're still adding over 200,000 jobs in the latest number. That 3-month average of non-farm payroll, still 240, 250K. It's really solid. We only need like 100,000 jobs per month just to keep the unemployment rate where it is. So if you're getting over 200,000, it's pretty good.
All right. So what does it tell us about the stickiness of inflation?
Well, I think if you're a policymaker, you're going to look at two things here. You're going to look at that 3.6% unemployment rate, and you're going to conclude that the risks are still toward inflation pressure. That's an unemployment rate that's very low. So we have very tight labor markets. I think you heard Powell last week. He said the goal for the Fed was to get the labor market in better supply-demand balance. And a 3.6% unemployment rate, it's really tight conditions. And then the second thing you'd look at, I think, would be average hourly earnings. again 0.4% month to month. So I've been hearing from a lot of the bears that, job growth is going to roll over, and also wage growth is going to roll over any second now. And that's just not happening. It's not playing out here. So I think this keeps the Fed on track to hike. We think they will hike in July at the July meeting. And we think they're on an every other meeting hiking pace right now. So that would imply skipping September and hiking again in November. So we get to 550 by year end on Fed funds.
What's so interesting to me is that the data and the Fed moves and the market moves are all over the place, but also the vibes of us regular folks out in the world. We just talked with an economist from ZipRecruiter who talked to us about how the majority of job seekers are feeling this pinch of market conditions, and they feel that they should take the first job that they're offered because they're so concerned with the economy. From where you sit, Jeffrey, does that square with what's actually going to happen in the economy, and what do you make of the feeling of anxiety with American workers, given that we continue to get these great jobs numbers?
Well, just talking to friends and family, we're being constantly told that the recession is going to start imminently, right? It's going to be next week, next month. We've been hearing that for a better part of a year now, really since last June. So if that is what the average person is hearing, I can understand a little bit of consternation. The data, though, the macro data doesn't really bear that out. I mean, in terms of labor demand, still very, very high. Job openings hanging out around 10 million. So we're still seeing pretty good labor demand. Now, it's down from the peak where we had extreme amount of labor demand, but it's still high relative to other cycles. So I still think it's a pretty good time to be in the market looking for a job. I think we also saw that with the quits data tick back up for May. Yeah, we saw that was the Payton and Regal chart of the week, if anyone's interested in checking that out. We just compared quits. This cycle are still well above what we saw at any point really in the 2010s. So I still think it's a better environment now. And that's good news for someone who's looking for a job or who's in the labor market. It's a better environment than it was for much of the 2010s. So that's good.
I don't want to get too geeky, but there was an economist, Rudy Dornbush. Among other things, he said that when things turn, they turn pretty quickly. Do you get a sense of that?
Yeah, we always say, like, the unemployment rate is a good example of this. It falls like a feather and it rises like a rocket. So you can see, looking at the unemployment rate chart, that exact story. So that's why we're always on guard looking at things just for the early hints and the early signs. Initial claims for unemployment, that weekly data that comes out tends to be a pretty good, sign, indicator of that. It ticked up recently, but it's been hanging out. I would say for the last 3 or 4 months, around 240,000 in the weekly claims data. So it's moved up. It's indicative of a slower job growth, but it's nothing worrisome. I don't think. I also think payrolls. It gets a lot of pushback, and people say, "Oh, it's a lagging indicator," but in real time, we're getting data for last month, for June. We're getting it released here, 7 days into the month. It's a pretty good real-time indicator from a bond market economist perspective. Always have relied on that. And as I started the segment, 244,000, the 3-month moving average of non-farm payroll growth, is a pretty good indicator of where we are. It's slowed down, so growth has slowed from a year ago, 6 months ago, but still very solid job growth.
So you're a bond market. He's a bond market economist, so that means you are a pessimist, does it not?
I'm supposed to be. Yeah, I'm supposed to be out here telling you that, inflation's rolling over. It's time to buy bonds, extend duration. But I would like to think that I'm objective. I'm just looking at the data here.
Yeah.
We're very far from the Fed's target on inflation.
Yeah.
The unemployment rate is very low. And I think their bias from policymakers is going to be to keep hiking. So that's going to keep putting pressure on front-end yields. So yesterday we did see 2-year yields creep above 5%, which makes sense to me. We're back below this morning. I think we'll move back above at some point. The Fed's got 2 more rate hikes. That's got to face the facts here. So that's what bond market participants have to face, those facts. Don't fight the Fed.
Okay, well, since you brought it up, I got to talk to you about the yield curve, because we are seeing a little bit of a moderation when it comes to the 2s, 10s inversion. Are you thinking that the bond market is seeing something that the Fed isn't when it comes to where this economy is going?
I go talk to our traders on the trading floor. They would tell you, yes, the bond market, bond investors are smart.
Right.
Maybe they are. But you think about the yield curve. I've always loved looking at the yield curve, but it can have long lags to when it actually signals a downturn. So I remember this very well. If you go back to say the 2006 era, if you were looking at the yield curve, you started to get concerned, but the recession didn't begin until end of 07. So people tend to go early if they just focus on the yield curve. So that's the thing. It could be long lags. It's not to ignore the yield curve. You got to look at, there's information there, but it could be long lags. I also think there's some unique features this time. I mean, inflation is higher than it has been at any time really in the last 40 years.
Yeah.
So in typical business cycles, you haven't really had to think about what's going on in the front end. Why is the front end so high? The front end is high in yield because the Fed is trying to stamp out inflation. I think the bond market has a bit different forecast for inflation than we do. The bond market has been perpetually expecting inflation to come down much more quickly. And so maybe that's the reason why 5-year yields and 10-year yields have been a bit lower. So as you pointed out, in the last day or so, the long end even moved up.
It's been
and
crazy.
Yeah, I think that's a recognition of the fact that, hey, things are, the economy's in better shape. We're not getting that recession everyone advertised.
Yeah.
Inflation is a bit more sticky. The Fed is going to be higher and maybe higher for longer. And that does tend to have some impact on 5 and 10-year yields.
And maybe a soft landing, you think?
Yeah, this morning one of my colleagues pinged me. He said, "Yo, this is Goldilocks. This is a soft landing report. We've got a very low unemployment. We've got a little bit of a slowdown in job growth. So it's possible." We wrote a piece at the beginning of the year. We said the case for a soft landing. It may not be the base case, but it's something everyone should think about. So we're leaning towards that. What in this I don't think was really a soft landing was probably the average hourly earnings, because that's still coming in a little bit hot. But
remember
if
that
the unemployment rate stays low as job openings come down, that's your soft landing. That's you think about the beverage curve kind of relationship. You get an easing of labor demand, and the unemployment rate doesn't rise. That's your soft landing. So it's possible with the 3.6 unemployment rate, we're on track for it. I wouldn't rule it out.
Now, keep in mind, Madison, the Goldilocks story that had 3 bears in it.
Well,
where are you? Because we got like 20 seconds left. Because I'm interested in anecdotal. What's the local economy there? I'm looking out the window. Where are you?
This is downtown LA. I don't know if you can see in the background. You can probably see the Hollywood sign. So that's where Payton Regal is located. That actually, if you want to be bearish, the story that I would tell is I would say, hey, look at the plot on your Bloomberg terminal, the California unemployment rate. It bottomed out about a year ago at 3.9. It's at 4.5 right now. So it's risen 0.6 percentage points, while the unemployment rate nationwide is low.
Got to run.
And California's a big economy, so that's the
world's
bearish
fourth largest there. Jeffrey Cleveland, Director and Chief Economist at Payton Regal. Thank you so much. This is Bloomberg. Let's get some company news with Bloomberg's Steve Rappaport.
All right, starting with labor law. A judge rules that Starbucks violated federal laws when it shut down a unionized store in New York. Let's get more on that from Bloomberg's Kimberly Adams.
A National Labor Relations Board judge concluded Starbucks shut down the store near Cornell University, in large part to discourage unionization efforts in Ithaca and elsewhere. All 3 corporate-run cafes in Ithaca voted to organize. Starbucks decided to close those locations, prompting the union to denounce the move as retaliation. The coffee chain argued the closures were justified, saying the Ithaca stores had numerous absences and high turnover. Starbucks plans to appeal the ruling. Kimberly Adams, Bloomberg Radio.
Thanks, Kimberly. Starbucks stock is little changed this hour. You'll need more than $3,500 to buy Apple's new Vision Pro headset. The tech giant is planning a retail launch with appointments and in-store promotion in some U.S. markets early next year. Apple will designate special areas in its stores with seating, headset demo units, and tools to size up accessories for buyers. Has ChatGPT reached a plateau? Well, according to data firm SimilarWeb, possibly. They're showing that it dropped in traffic. Mobile and desktop traffic dropped nearly 10% in June from the previous month, and that marks the first decline since ChatGPT launched in November. You might recall the tool was quickly embraced by workers and students, though many schools and companies quickly changed course because of potential data leaks and also the concern about ChatGPT sometimes providing false information. Those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg. Bloomberg Markets continues right after this.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:21 on Wall Street. We do check markets all day long at Bloomberg. We are looking at a mixed market right now with the Dow lower, little changed, well off session lows right now. We've got the S&P up 12, a gain there of 0.3%. NASDAQ higher by 75, a gain of 0.5%. And the Dow, by the way, now lower by 3 points, down less than 0.1%. The 10-year yield, 4.03%, with the 2-year 4.91%. It is Jobs Friday. Hiring data remained high enough to quash speculation that the Federal Reserve will leave rates unchanged later on this month. Reaction to the jobs report from Jeffrey Cleveland, chief economist at Payden & Regal, who was interviewed moments ago right here on Bloomberg Markets.
Maybe the job growth is slowing a bit, but nothing close to a recession. And I even hesitate to call slowing. I mean, we're still adding over 200,000 jobs in the latest number. That 3-month average of non-farm payroll, still 240, 250K. It's really solid. We only need like 100,000 jobs per month just to keep the unemployment rate where it is. So if you're getting over 200,000, it's pretty good.
And again, the 10-year, 4.02%, with a 2-year, 4.91%. Spot gold up $18 the ounce, up by about 1%. West Texas Intermediate crude right now up 1.7%, 71.06 for a barrel of WTI. So again, recapping here, we're looking at a mixed market on this Jobs Friday, with the Dow Jones Industrial Average now lower by about 11 points. S&P higher by 10 for the S&P. That is a gain right now of just about 0.2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right. Thank you so much, Charlie. Really appreciate it. We're going to continue to cover what's going on in the equity space. As Charlie mentioned, a little bit mixed reaction to that jobs non-farm payrolls number this morning as the market kind of digests what's going on here. Right now, we are going to speak with Phil Orlando. He is Chief Equity Market Strategist and Head of Client Portfolio Management. And he is on Zoom with us here to discuss. Phil, thank you so much for getting on the call with us here. Talk to me about what your take is on today's trade. We've got lower volume than usual, but a little bit of a mix across the board.
First of all, Madison, thank you very much for having me on. The mixed market, I think, today reflects the mixed payroll picture. I'm working on my client note this morning, and my headline is going to be mixed payroll picture. You've got some elements of the report that were cooler than expected, other elements that were much hotter than expected, and the net of it is, importantly, that when the Federal Reserve meets in a couple of weeks on July 26th, we're expecting another in a series of quarter-point rate hikes. So I think the market's trying to digest those disparate elements of the report this morning and figure out what it means for the Fed, the markets, the economy, corporate earnings, and it is very much a mixed picture.
So, Phil, rising rate environment doesn't sound like it's great for the technology trade or banking.
Well, no, you're right. As we look at things, the continued increase in interest rates, and at this point, you've got to pencil in, or at least we're penciling in, 2 more quarter-point rate hikes from the Fed over the course of this year. Theoretically, that should constrict price earnings multiples. Now, you look at the performance of the S&P 500 in the first half of the year, and it's really been a tale of 2 markets. You've got these 8 big technology companies. I'm sure you've heard about this analysis. Apple, Microsoft, NVIDIA, et cetera. These 8 stocks, which account for something like 28% of the market cap weight of the S&P 500, they're up in the first half of the year almost 60%. You strip those 8 companies out of the S&P 500, and the other 492 stocks in the S&P are up like 3%. So if you're in a continued interest rate environment, higher interest rate environment, that theoretically raises the rate of unemployment, slows economic growth, corporate earnings growth, contracts multiples. the froth associated with those 8 technology stocks ought to result, at least we think, in some sort of reversion of the mean at some point in coming months and coming quarters. Now, has that already started? Is it going to happen tomorrow? Timing, of course, is incredibly difficult to predict here. But our best guess is that, we should have a softer summer and softer fall based upon the equity market sort of reevaluating, what a tighter Fed means for the markets and the economy.
To what extent, then, when you look at those big 8, do you view Apple as kind of the key bellwether here, particularly when you look at the relative strength index of a name like Apple, obviously doing incredibly well this year, but just this week they have started to come down a little bit when looking at the relative strength index, getting just a touch closer to those 50, 100, 200-day moving averages?
Look, the reality is that companies like Apple and Microsoft are phenomenal companies.
Yeah.
They probably ought to be in everyone's portfolio. They're well managed, they're well positioned, and the stocks deserve to do well. The question that we're asking is, do they deserve to do as well as they've done since the market bottom last October, and are valuations a little bit ahead of themselves? NVIDIA is probably the poster child of this AI FOMO trade that we've seen over the last 8 or 9 months. We looked at valuation the other day, and since the bottom of the market last October, NVIDIA has literally more than quadrupled in stock price. It's gone from like $100 a share to north of $400 a share. From a valuation standpoint, it's trading at something like 30 or 40 times forward revenues, trading at about 130 times forward earnings. Now, that's not to say that NVIDIA is not a great company. It's not to say that they're not going to participate significantly in this artificial intelligence boon that we're going to experience over the next 5 or 10 years. But we raised the same questions back in the late 90s, as we were approaching the Y2K calendar changeover situation. And the NASDAQ composite, you may remember, surged by something like 90% in the fourth quarter of 1999. Now, should technology stocks have done well at that point because they were a solution to the Y2K calendar changeover? Absolutely. But stocks got ahead of themselves. And what happened as we got into the first quarter of 2000 is that technology stocks started to correct, and they didn't stop correcting until they had given back 80% of their gains over the space of about 3 years. Now, I don't think that we're going to have an 80% correction in the market or tech or NVIDIA or any of that. But what I'm suggesting is that maybe we've gotten a little too frothy here, over the last 8 or 9 months, and maybe there's a little bit of a reversion of the mean trade coming as we get into second quarter earnings, and maybe some of the guidance from company management is that, artificial intelligence is a really cool thing, but maybe we've gotten a little too enthusiastic here in the last couple of months.
By the way, I don't think Madison was born in 2000, but that's
I
my,
was
that's
6
my
years
guess, Phil.
old. Okay.
How old were you?
I was 6.
She was 6,
So
Phil.
I was watching
Putting on the
market
trades.
moves.
Yeah. Hey, is it time for me to get boring and start looking at defensive shares?
Nice.
Well, I think that's exactly the point that we'd raised, that you've got defensive stocks trading at, 10 times earnings, dividend yields, 2 or 3 times the broad market average. And even if the economy slows, maybe it goes into recession at some point in the next 6 to 12 months. And that's the question that everyone's asking. We're still going to need to buy healthcare, consumer staples, utilities, energy companies. And these stocks are, trading at very reasonable multiples with very generous dividend yields. So why not play a little defense here? Hunker down, preserve some capital. Look at how the market performed last year, calendar 2022. The overall S&P last year was down about 20%. All right, it wasn't a great year. But when you look at the value versus growth trade last year, growth stocks were down 40%. Value stocks were down 10.
Yeah.
Now, that corrected, in spades from October up until just recently. But is it time for us to enjoy perhaps another rotation? Lock in some of those growth tech profits, rotate some of that money into the undervalued value stocks, and I'd throw international and small cap sort of into that bucket as well, and see where we stand 6 months from now.
Okay, so Phil, final 30 seconds. Are you repositioning in that exact way, and what is that looking like?
We're not repositioning. We're there. And I will tell you that maybe we did that a couple of months too early. But that's exactly the trade we're looking at. And I'm not suggesting that we take growth and tech to zero.
Right.
We're just saying go slightly, below neutral, go a little overweight on the defensive names, and let's see how the next couple of quarters play out.
And as Phil is speaking, the tech-heavy NASDAQ is up 67 points right now. He turned it around.
He turned it around. Finally,
Thanks,
I have
Phil.
something to say when I do my markets checks today. Phil, really appreciate you joining us on this Friday to talk about what's going on in today's trade. We really appreciate it. Again, that was Phil Orlando. He is Chief Equity Market Strategist and Head of Client Portfolio Management at his firm. As we were talking about this, and as John Tucker did an amazing job pointing out, the NASDAQ finally getting a little bit of movement, up by 0.6%. The S&P up by almost 0.4%. The Dow Jones looking a little bit unchanged on the day. This is Bloomberg. Let's get to some world and national news with Bloomberg's Nathan Hager.
All right, Madison, thank you. The World Health Organization has fired 7 people for sexual misconduct in the last 6 months. We just got that word from the UN agency's Director of Prevention and Response to Sexual Misconduct. He says they got 48 allegations in the first half of this year, and the firings include people at the director level. WHO was rocked by sexual assault claims against 83 aid workers in the Democratic Republic of Congo during the Ebola response from 2018 to 20. The Republican Attorney General in Kansas is now asking a state court to block transgender residents from changing the sex on their driver's licenses. Chris Kobach says a new gender-defining law that took effect last weekend requires the state to reverse all sex changes in its records, including about 1,300 in the last 4 years. Democratic Governor Laura Kelly said last week the bathroom law does not apply to public records, and her office would continue allowing changes to transgender licenses. Treasury Secretary Janet Yellen says competition with China should not be winner-take-all. She met today with Chinese Premier Li Qiang after airing concerns about China's new metal export controls with U.S. business leaders in Beijing. We get more from Bloomberg's Jill Desis in Hong Kong.
It's really this weird situation where you can't just cut off all economic cooperation between these two economies, but at the same time, they fundamentally disagree about a lot of different issues, primarily about national security, and that's really sort of poured over into how they affect each other's trade and sort of how they, how they trust each other, or in this case, really mistrust each other.
Bloomberg's Jill Desis reports Premier Lee struck a softer tone as well. He said relations with the U.S. will eventually see a rainbow after going through wind and rain. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:40 on Wall Street. We do check markets all day long at Bloomberg. A substantial turnaround for the U.S. stock market with the Dow, the S&P, NASDAQ 100 index, and the Russell 2000 now very much in the green. A 21-point jump right now for the S&P at 4433, higher now by about 0.5%. We do have the Dow up 60, up by about 0.2%, and the NASDAQ Composite Index up 99, higher by 0.7%. Cannot ignore the Russell 2000 Index today. Small cap shares higher by about 1.8%. We've got the 10-year yielding 4.03%, and the 2-year 4.91%. A spate of jobs reports tamping down speculation that the Federal Reserve will leave interest rates unchanged later this month. Reacting to this morning's jobs report, here's Phil Orlando, Chief Equity Market Strategist at Federated Global. He was interviewed moments ago right here on Bloomberg Markets.
You've got some elements of the report that were cooler than expected, other elements that were much hotter than expected. And the net of it is, importantly, that when the Federal Reserve meets in a couple of weeks on July 26th, we're expecting, another in a series of quarter-point rate hikes.
And again, we do have the 2-year at 4.91%. You can hear more of that conversation on the Bloomberg Tapes podcast. You can download it wherever you get your podcasts. Spot gold, $16 higher the ounce now at $19.26, up by about 0.8%. West Texas Intermediate crude up 1.9%, $73.17 a barrel. Starbucks violated federal labor law when it shut down a unionized store in Ithaca, New York. That according to a labor board judge. The National Labor Relations Board judge ruled that the shutdown of a store near Cornell University's campus was, quote, done in large part to discourage unionization efforts in Ithaca and elsewhere. Right now, Starbucks shares are up by 0.3%. Recapping, though, we are looking at a move higher now for the S&P, up 21 points, up 0.5%. 10-year yield 4.03%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right. Thank you so much, Charlie. I know that you and all of our colleagues here at Bloomberg already have your plans to go see the Barbie movie.
Charlie, seriously, didn't you actually threaten to go see this
movie
as a matter of fact,
yourself? I think I said, well, no, listen.
And then I said, no, you can't go because it's creepy.
And that message was echoed by my wife. However,
He was going to go see this
so here's the compromise. There is a pop-up restaurant where you can go and do those things here in New York. So instead of going to the movie, we'll wait till it comes out, wait till it streams. But no, we're going to go to the pop-up restaurant instead. So.
Okay, there you go. So interacting with the brand regardless, Charlie. Thank you.
Yep.
Thank you so much. But yeah, seriously, this is very exciting stuff. Me and my friends are all really pumped. I know that you'll be joining us at the theater, John, for the new Barbie movie. One of the reasons we're so pumped is because of the amount of money getting poured into branding for the film. So we're going to talk about all of this. It's today's big take story, and we've got Kelly Gilblom on the line, our Bloomberg News editor out in LA, to discuss it with us. Kelly, thanks for being patient with us as we talk about our love of Barbie.
Is this a kid movie or an adult movie? I mean, for older people, not adult movie.
Yeah, thank you for your interest in Barbie. It's actually not really a kid movie. It's rated PG-13. If you've seen the trailer, you can see that it has a lot of sexual innuendo and
so it's not
humor.
creepy if Charlie goes to see it by himself.
John,
it's for adults.
It's for adults. Well, and it was very expensive to make, and so it's a big bet on those adults coming in to buy tickets, right, Kelly?
Yeah, it was very expensive to make. It was $100 million. Mattel, which owns the Barbie brand, didn't actually pay for the budget. It licensed the brand to Warner Brothers, which covered the budget. But Mattel is definitely taking a big bet for itself on the overall perception of the brand. If you recall hearing about Barbie dolls at any point in your life, they can be pretty controversial. So they're really hoping that people are more endeared to them after this movie comes out.
Yeah, well, and also it's interesting because they have a tough challenge with the Barbie kind of stereotype that they have to sort of rebrand as like a new age feminist character. What can you tell us, Kelly, about the likelihood of Warner Brothers being able to do that?
It seems like from the response so far, they've mostly managed to pull it off. Everything about it has gone viral. People are so excited. The box office tracking figures keep going higher and higher and higher. And it's one of the rare movies that's actually targeted toward women. You know, we calculated only like 6% of movies with this type of budget are for women. So I do think it will make a big impact and could possibly pull off this reputational move that they're trying to make.
The story is great. I mean, it's the history of this is fascinating. Well, to the extent that it can be fascinating to somebody like me. But there's actually Barbie and Ken are actually named for the founders of Mattel, their kids, right?
That's right. Yeah, Ruth Handler was the inventor of Barbie and one of the founders of Mattel. It's longtime chief executive officer and in control of operations there. And yeah, she saw a German doll that was actually for adults.
Let's be clear. This is a German sex doll on which Barbie is based, right? Do I have that correct?
I mean, it was for bachelor parties. People, sent it around as a gag gift, and she thought it would be great for, if she kind of remade it, more targeted for kids, would be great for her daughter Barbara. And then a few years later, Ken rolled out.
Yeah, and
Ken, her brother, by the way.
Right. Very
he rolled out.
You always bring us the fun facts here, John. I also feel like, Kelly, Greta Gerwig as the director here is an important choice because she has kind of a history of making these inclusive films that center female characters as the main subject.
Yeah, I think she's one of the preeminent female coming of age genre directors, writers. She's come to prominence in recent years, especially with Little Women, her remake, and with Lady Bird, both Oscar nominated films. I think one actually won an Oscar. So that was a big get for them. And it was actually Margot Robbie, who's playing Barbie, who was able to make that connection and recommended her as the screenwriter.
Oh, cool. I didn't know that. That's really cool.
Now, is Barbie, what does this do for Barbie? This film, if it's a flop, does Mattel get crushed? Is Barbie even relevant anymore?
I think that's the big question for Mattel is how relevant is Barbie going to be? It really went through a crisis, the whole company did, because Barbie fell out of step with society. They remade the doll in 2016 and made it more inclusive with different body types and that sort of thing. So this is trying to showcase that work, but it doesn't really, analysts aren't really seeing a big toy sale bump in 2023. It could be more long term, and I think the real value for Mattel would come if they can turn it into a broader franchise, like a Marvel type of franchise, where you have a Ken movie spinoff and a Skipper TV series and a, roller coaster and that sort of thing.
I was traumatized by Barbie. My sisters had it, and they used to take the legs and they'd hit me with it. So I have these like two little bruises where Barbie's breasts hit me in the, it's just like.
I'm sorry to hear that, John.
Yeah,
hopefully
tough.
you can
That was a tough household growing
You can go
up.
watch this movie and get a little bit.
Has
of
anybody
closure.
seen it yet, or is it you're waiting for reviews and all that stuff?
It's coming out in July, right, Kelly? Later this month, couple weeks.
That's right. Some people have seen it. They're all critics. Their review should start coming on the 13th, and then its world premiere is on Sunday. But it's released wide on July 21st.
Thank you, Kelly. For those listening on radio, not seeing us, my hand is physically out in front of John to kind of control the commentary here when it comes to Barbie.
I thought you were going to hit me with your Barbie.
All right, Kelly, thank you so much for joining us. Sorry, things are getting a little crazy as we wrap up our show, but it's an incredible story. It's today's Big Take. You can find it on Bloomberg.com or on the terminal, wherever you get your Bloomberg news. It's also the Big Take podcast, which you can download wherever you get your podcasts as well. It's incredibly well researched. They go through everything when it comes to Mattel and the Barbie movie. Highly recommend giving it a read or a listen over the weekend. Having said that, market's looking a little bit mixed still today, but finally seeing a little bit of green on your screen. We're covering it all right here. This is Bloomberg. Let's get some company news right now with Bloomberg's Steve Rappaport.
Bye Bye Baby is going to bed permanently, Bloomberg's Dan Schwartzman reports.
Steve, Bye Bye Baby stores will close after it failed to attract adequate going concern bids in a bankruptcy auction. New Jersey-based baby goods company Dream On Me Industries won an auction for Bye Bye Baby's intellectual property last month, but advisors kept searching for a buyer for the whole business. The unsuccessful sale caps a tumultuous period for the brand and parent company Bed Bath & Beyond, which is also shutting down. Bye Bye Baby was a key part of last-ditch efforts to keep Bed Bath & Beyond out of bankruptcy. Steve?
Thanks, Dan. Shares of Tesla are up less than 1% as the EV maker starts laying off battery workers at a plant in China. Bloomberg's Ed Ludlow has more.
There are 20,000 people that work in that Shanghai plant. What we're talking about is individuals on the team that take the cells from third-party suppliers and assemble them into modules and packs. One source told us that an element of this is because there is an aspect of automation that can replace some of those jobs. But this comes at a time where we are talking quite a lot about the price war, quote unquote, in China.
Thanks, Ed. Earlier this week, Tesla and more than a dozen Chinese EV makers entered a pact to maintain fair competition and avoid abnormal pricing. Twitter is threatening to sue Meta Platforms over the launch of its new app Threads. Twitter attorney Alex Spiro sent a letter to Mark Zuckerberg accusing Meta of unlawfully using its trade secrets and intellectual property by hiring former Twitter employees to create a, quote, copycat app. A spokesperson for Meta says no former Twitter employees are employed with Threads engineering team. I'm Steve Rappaport, and this is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, everyone, I'm Madison Mills here with John Tucker, wrapping up our 3 hours of markets coverage. This is the last time that I have the honor of getting some world and national news with the one and only Nancy Lyons.
Thanks, Madison. U.S. Treasury Secretary Janet Yellen is in Beijing, where she's been holding economic talks with Chinese officials and business leaders, and also speaking at a roundtable discussion. She says it's in the best interest of the U.S. and China to have direct and clear lines of communication at senior levels.
In the economic realm, regular exchanges with our Chinese counterparts can help us monitor economic and financial risks, and it can help create the conditions for a healthy economic relationship between our two countries.
Yellen also says competition between the two countries is not a winner-take-all situation, but she says they do need to manage their rivalry with a fair set of rules. While Treasury Secretary Yellen searches for common ground between the U.S. and China during her trip to Beijing, the White House is calling on China to do more to stop the spread of illicit synthetic drugs like fentanyl. Bloomberg's Amy Morris has details.
Assistant Secretary of State Todd Robinson says China, quote, needs to do more as a global partner to disrupt illicit synthetic drug supply chains, something Secretary of State Antony Blinken pushed during his visit last month. Robinson says that so far there's no indication China plans to join a new U.S.-led coalition of 84 countries working to disrupt the spread of fentanyl and other drugs. Private Chinese firms export many of the chemicals used in creating fentanyl. In Washington, I'm Amy Morris, Bloomberg Radio.
This afternoon, President Biden will be announcing steps that his administration is taking to help lower health care costs. Among them is an effort to close loopholes on insurance plans that often provide reduced coverage, and another one that would prevent providers from evading billing regulations by contracting with hospitals defined as out-of-network. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Madison and John.
All right, thank you so much, Nancy. Finally seeing a little bit more green on the screen. The NASDAQ up by about 0.7%, S&P up by about 0.5, and the Dow Jones sneaking closer to 0.2% there. So a little bit more conviction, still low on volume for the day. Having said that, we do want to wrap our show with a story about the Manhattan real estate market, something that John Tucker and I are both incredibly passionate about. Julia Koch, as we know her, the widow of billionaire David Koch, she sold the couple's Manhattan townhouse. The sticker price, $41 million.
Oh, this was a private. This is not like when you're one of the Kochs, you don't call up your real estate agent.
Yeah, I guess not.
It's just like these are private sales that take place here.
Yeah, okay, tell me, John, which of these is the most appealing aspect of the house to you? 8 bedrooms, spa, media room, and a sports court.
Actually, none of those. Just the proximity to work is probably the only thing going for me with this.
76th and Park, not a bad location there. Also, I should mention, this is not her first rodeo when it comes to Manhattan real estate. She purchased 2 Upper East Side apartments from the estate of Microsoft co-founder Paul Allen for a total of $101 million.
And let me guess, they combined the two to make one gigantic pad.
I guess so. I don't want to be in a house that's that big in this city. You know what I mean? Like, I want to be able to see everything.
Yeah.
Just to know, like, who's in there. You know,
So
this
is your real estate
disagree
fantasy.
and I hate you. Yeah. Also, John, you flagged a really important story about how the wealthiest in Manhattan are buying homes with.
Well, more and more, it's just pure cash.
Pure
I mean,
cash.
there's no, mortgage rates are going up. So what?
Yep.
It's just like a lot of these folks aren't affected. And my commute involves 57th Street, Billionaires Row, right? And you know how many of those people who live in those billionaire duplexes and penthouses live here full time? None.
None. I know. I wish I could get in there, but I do, as you know, I live a block away, so I really can't complain about my commute. We have completely opposite commutes. All right, everyone. Thank you so much. This was the time of my life, sitting here with John Tucker for the past 3 hours.
A distinct pleasure.
A distinct pleasure and honor. Continue to stick around here with us. You're going to get a lot of fantastic news with the one and only Joe Matthew coming up next, because Sound On starts right now.
From New York City, for our viewers worldwide, I'm Shonali Bassick, and Bloomberg Real Yield starts right now. Coming up, the June jobs report shows a cooling labor market, setting up for a potential turning point in the economy. And the question now becomes, can the Fed keep its hawkish tone? We begin with a big issue. Does a weak jobs report change the rate path?
Labor is the key.
Miss on job creation.
Little softer on the headline.
This will not get in the way of the Fed hiking in July.
3.6% unemployment rate.
Still looking at a very tight labor market.
Labor market remains quite resilient.
Labor markets have to soften.
We really need to see the job market start to crack.
The threat of a hard landing is really low here.
This economy is strong enough to avoid a recession.
The Fed has to break the labor market.
The Fed is going to have to choose.
At the end of the day, this is going to be a big concern for the Fed.
Hike in July.
Fed's gonna keep moving.
At least 2 hikes.
Fed is going to hike.
The stronger the data comes in, the more aggressive the Fed ultimately needs to be.
Joining us now is PGIM's Greg Peters and Deborah Cunningham of Federated Hermes. You know, there's nowhere else to start but the short end of the curve here because we've come round robin this week. We have surged past 5% just yesterday, and now we are back down to 492 or so. You know, if you take a look at what the market is telling you, what is the discrepancy between the data we're seeing today and the possibility that inflation could still come in hot next week? Greg, get us started here.
Yeah, so I think the market's been wrong for the past 2 years, to be honest with you. So I wouldn't take much faith or stock into it. But I think the markets are finally starting to slowly at least recognize the Fed means what they say, and they still have to shake inflation out of the system. But it'll be an uneven, volatile path. But you're starting to see this repricing in the front end that makes a little more sense to us. If you recall, if you go back to March, you know, during the banking swoon, I mean, we were pricing in pretty substantial cuts into this year, and that's slowly being taken out of the market, and that makes sense to us.
How do you feel about it, Deborah? When you look at the move backward today, does it make sense to you on the heels of this jobs report?
You know, we really should listen to the Fed a little bit more. I agree. To the extent that the labor market is starting to pull back a little bit, it's just beginning that process. And certainly what we've seen, even with the report today, you know, when you take the revision into account, it's still a pretty positive number, especially when you consider how positive it was last month. And when you look at it kind of on a moving average basis, you know, it takes it down from what was maybe 247,000 down to 244 on a monthly basis. That's not that much of a change. I don't think that is something that the Fed is going to find comfort in, at least not enough comfort to want to change what seems to be a pretty consistent Fed speak across, you know, basically all the governors and those that have been, you know, talking in the most recent weeks or so.
It's truly kind of a chorus here for higher for longer. I want to read you both a quote today from Jim Bianco, a conversation I had this morning of Bianco Research. Maybe there's something more to break here, he says. We'll see, but the direction of rates is still higher, and the market isn't fully embracing this idea. As the market waits to catch up, Greg, where can they be caught off guard here as they expect rates perhaps to lag what reality has shown to be true?
Yeah, so I think this is a lagging effect. We don't know. You know, commercial real estate is, you know, considered the canary in the coal mine, but it's really not dissimilar to, you know, levered cap structures elsewhere, right? So the world has really benefited, both real estate and corporates benefited from the zero to negative interest rate policy for quite some time. So this adjustment factor is well on its way. And if you believe, like we do, that, you know, rates will remain higher for longer, we've been really leaning against this notion that the Fed can cut here, given where inflation is, then, you know, there's probably a lot more breakage on the follow here.
Breakage. Deborah, if you think about breakage, and even when you're thinking about the lagged effect of interest rates, or even the future effects that we might see from higher interest rates, what are you most concerned about in credit markets to break?
Well, first of all, I don't think that 5% is an inordinately high interest rate environment. Maybe if you've only been in the market for the last 15 years, where 12 of those 15 years we've been at 0%, does 5% seem high? But in the context of a broader historical time frame, 5% seems maybe 100 basis points higher than the average, 75, something like that. As far as breakage goes, everybody is always looking to the banking system, and certainly, as was mentioned, the commercial real estate sector is one that will be impacted, not only with a higher interest rate environment, but also because of the effects of COVID. But, a couple reminders. Number one, not all commercial real estate is created equal. So, if you look at commercial real estate that's multi-housing, it is, at its peak from a strength perspective. Whereas on the other side of the equation, if you look at it in the context of office building, multi-use office building, there you're, kind of further down in the doldrums. I think another thing from a bank portfolio perspective is to understand how that all plays out, not just commercial real estate, but what the segments are, what the relative geographic locations are of those segments as well. And then finally, when you look at the securities portfolios for the banks, similar to what was going on with Silicon Valley Signature Bank back in March, ultimately the Fed has fixed that problem for a year with the bank term funding program, and to the extent that that year doesn't give us enough time to get interest rates back down to where either a majority of those lower rated securities that are held in banks' portfolios either are maturing off or are much shorter term in nature, there's the expectation, I think, in the market that the term on that facility would be extended, 6 months or a year, to continue to allow that to facilitate, no breakage or very little breakage in the banking system.
Well, Deborah, maybe expand on that really quickly here. Does this mean that this market is still very much on life support?
I'm sorry, does it mean that the market is very much on
life support, the Federal Reserve's life support?
Oh, life support. Sorry. I don't think it's on life support. Certainly there are banks that grew inordinately from a pace perspective over the course of, call it, the last 2+ years. And in that, maybe the securities that they own or even some of their, lending practices have been done at much lower rates. And there is the facility that's allowing those to kind of catch up, those securities, those high quality securities. They're for the most part Treasury securities. So there's no credit issue associated with them, but to catch up from a market pricing perspective. So I wouldn't call it life support. I think there's probably maybe some bridging the gap, let's call it.
Greg, I want to also bring up, when we take a look at performance over the year, this was supposed to be the year of the bonds, the fixed income comeback. And when you look at performance overall, you are in the green for the year, but it's not by much. It's not this great comeback that the market was expecting when you look at the Bloomberg Ag here that encompasses kind of a range of debt. And some of the riskier ones are really helping that benchmark pull higher. When do things really start to turn around for the fixed income investor?
I don't think you want it to turn around necessarily. Let's get back to basic principles here. Fixed income is about income and it's about yield. And the fact that yields are higher, all else equal, that's a very good thing. So we're in this very volatile period, of course. Last year was a great lesson, I think, of what happens when rates are extraordinarily low and there's a repricing. At these higher levels, there's much more cushion. I think fixed income is in a much better place. And in fact, I really lean against this notion that we have to have Fed cutting cycle to really boost fixed income. I think that's the opposite of what we want. We want to keep yields higher here, get the income component. The old roll and carry game, I think, is incredibly important. And just kind of the flip side of what was being talked about before, I think we have a discounting problem, right? So, all these cash flows, all these valuations were based off of much lower interest rates. The fact that interest rates are higher today changes the valuation construct, at least on the riskier side, i.e. equities, that actually puts fixed income in a much better position as a consequence.
Greg, with somewhat of a sanguine view here, do you dip into more risk when it comes to the corporate debt market? You have some really significant sell-offs today when you look at the likes of HYG or LQD, the tickers that really encompass high yield and investment grade corporate debt. Do you recommend buying at these levels?
No, I don't think it's about this student body left, student body right game that's been played over the past decade, right? It's more about dispersion and picking your spots. But there's real value, in our opinion, in higher quality assets, structured products, short duration, those types of things really look attractive to us. The more levered capital structures, let's say the triple Cs, even the levered loans, that area seems very exposed still. So while we see a lot of value, we don't see it broad-based, and we definitely don't see it in the more riskier end of the scale.
Deborah, what's the setup for the second half here? What is possible to buy with the setup of where the 2-year is?
You know, I think you're continuing to maybe be a little bit north of your benchmarks from a duration perspective, maybe a little bit, looking towards a steepener from a standpoint of yield curves. But quite honestly, they're modest in the context of the movements that have occurred so far since the tightening cycle began back in March of 2022, very modest for the second half of 2023 in comparison to what we've been through so far. And I agree with Greg to some degree. We're in that almost mode of coupon clipping, to use an older term, where the price may go up a little bit, the price may go down a bit, but it's not going to be the total return aspect that at that point that's being driven by that price. The total return instead is going to be driven by the coupon.
That's Greg Peters and Deborah Cunningham. Thank you both so much for your time. Up next, the auction block. Yankee banks are helping to drive issuance this week. This is Real Yield on Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
The top names in business are on Bloomberg.
For Indigo, this is a 500 planes order. That's the biggest order ever in terms of number of planes. It doesn't change the short-term perspective on ramping up the production.
All our aircraft deliveries are delayed. The supply chain that was really decimated during COVID.
It's a real challenge for all the OEMs at the moment, but we absolutely have to have those aircraft delivered on time.
Nobody covers business like Bloomberg, your global business authority.
I'm Shonali Bassick, and this is Bloomberg Real Yield. It's time now for the auction block, where we had to shorten holiday here in the United States, but it didn't stop the level of issuance here. European markets are surpassing expectations for the week. Avis and others helping to fuel more than 25 billion euros in sales. Here in the United States, foreign-based issuers like Deutsche Bank and Nomura drove volume to the upside of projections with almost 15 billion priced in. And it was quiet in U.S. high yield with no sales this week, but we did learn about $9.4 billion of debt, which includes high-yield bonds and leveraged loans, is being lined up to back GTCR's purchase of a majority stake in WorldPay. Earlier today, we talked to Marathon's Bruce Richards, who discussed spreads amid his call for higher default rates.
There's a big bifurcation of quality. And when you look at the double B credits in the high yield market, that's a much better quality index than it ever has been. So you don't have many of those companies because they chose to lock in fixed rate bond yields as opposed to floating rate. I'm referring to the companies that took out floating rate notes in both the private credit markets as well as the syndicated loan market. That's where you're seeing the pain right now. Those are the companies that are most highly levered and that are showing the most stress as it relates to debt service.
Joining us now is Morgan Stanley's Vishy Tirupur and Peter Cheer of Academy Securities. Thank you both for joining us. You heard Bruce Richards. You also see a lot of folks on the distress side raising a lot of money for what they think is a slow-moving car wreck. High yields don't tell that story. I'm wondering, Vishy, what's got to give?
I think the point that your previous guest made is very valid. I think this is going to be, this market sets itself to be a market for dispersion and decompression. There is going to be a very much quality-dependent decompression ahead of us, and the most vulnerable part of the credit markets, or indeed the floating rate dependent, broadly syndicated leveraged loans, or similarly, all other kind of financing that is floating rate dependent. And we think that as of right now, we don't have a huge wall of refinancing, but if you go ahead 6 months ahead from now, I think the wall of refinancing begins to start to mount, and as this starts to mount, to give you a number, if you look 18 months ahead, in the leveraged loan and the high yield bond market together, it's about 120 billion of debt that needs to be refinanced sitting today. You go 6 months forward, that 120 billion becomes 260 billion. So it starts becoming a concern as we go down. And there you confront the challenge of having to refinance at significantly higher interest rates. So that is going to be a challenge for the more levered parts of the credit markets.
I'm wondering, Peter, when you take a look at kind of the movement you saw into LQD and even HYG earlier this year, do you think that the people who are feeling that this part of the market would hold up, at what point do they start to experience losses if the environment were to turn even further and if rates stay higher for longer?
They might, but I think right now, actually, credit still looks relatively cheap. If you go back to where we were in 2018-19, we're much wider on a spread base. You're seeing VIX come down. VIX tends to be somewhat correlated with CDS spreads and credit spreads in general. So I think there's room for credit spreads to tighten actually further from here. When I look at the high yield market over the last 10 years, it has changed dramatically in who's issuing. So the overall quality is much better. The companies are public companies, you tend to know them. They've got a lot of research being done on them, not just on the debt side, but also the equity side. So I think it's a much safer market. And I think people have actually been a little bit reluctant, even with those flows you talked about, to heavily invest. So if anything, I think you're going to see spreads do reasonably well over the next 3 to 6 months. And credit's very well positioned for any sort of recession risk if we get it. And if we don't get it, there's even more room to tighten.
Do you feel as sanguine about leveraged loans here? I know they're floating rate, but they can really be, we've seen them hit very recently. Do you think that this is the time to get in?
No, I'd be much more cautious in there because, again, I think that's where the smaller deals kind of found their way. To me, CLOs were the big driver of leveraged loans. CLO money came in. Your job as an asset manager, if you're running CLOs, is to invest it so you can go and raise a new CLO. So I think there was probably less work done on some of those credits. They tend to have more private credits. Some don't have all the financial information readily available to everyone. So if there are problems, it's going to occur there. But having said that, I think what we're going to see is CLOs act like bankers of the past. where bankers used to extend and pretend, right? So they didn't force companies into bankruptcy. They like to extend, change the terms a little bit. So I think the CLO market's very well positioned to negotiate with these leveraged loans. So I think the default cycle, if it comes, will be pushed off down the road just because of that flexibility.
Now, I want to pull up a soundbite here from Jason Furman, because there is a small, but it's a pretty loud camp out there that says it's not about 2 rate hikes. There's a potential for 3. Take a listen.
I think interest rates are going up more. I think we're going to have, I wouldn't be surprised if we have 3 more hikes this year. That's going to, put some even greater pressure on depositors unless banks match that with interest rate increases.
Now, higher for longer, there's an obvious worry for depositors. There's an obvious worry here for banks. There's an obvious worry here for other types of corporate borrowers. Vishy, how reasonable do you think it is to start thinking about 3 rate hikes? Do you think that this is very unlikely, or do you think that there's a slim possibility here that things might go much higher for longer?
Well, I think we will say the July hike, we expect to see a 25 basis point hike in July, and given the data so far and given the trends in the data so far, we think the Fed will be done at this point. But it is a data-dependent world. There is a lot of uncertainty about how data evolves, and we will, depending on how the data evolves, I think the monetary policy will follow how the data evolves. So I think the key data that we'll be focused on is the labor market. And we have seen today's data does not do anything for us to either take away the cut in July or add a cut in September. So both today's data basically reaffirms what we are thinking would be the case for the July. We're very much there. But I didn't see anything in the data today that calls for another September hike. But there is more data to come by September. By September, we'll have 2 more non-farm payroll numbers. We have 3 inflation prints. We'll see in September.
Mm-hmm. Peter, how do you feel about this idea of 3 hikes, and what does next week's CPI bring to the table?
I'm very dubious about this. I think we've all gotten so used to talking about the Fed this, the Fed that the Fed's pretty told us, as far as I'm concerned, that they have an incredibly high hurdle to cut rates this year, and they have a pretty high hurdle to hike more than once. So maybe we get 2 more this year. I think they're going to be slow. They're going to take times in between meetings. They're going to see what the data looks like. No single data point is going to change their mind dramatically. So I think there's a little bit too much hype about where rate hikes are coming. I think one's baked in. Maybe we get a second one. But again, I think that hurdle is going to be high. It's going to be very data dependent. And it's going to be incredibly difficult for them to cut. So I think we're kind of on cruise control with the Fed until year end. And as we move into next year, they're going to want to be pretty cautious about hiking and causing some sort of recession during an election year, because that's disastrous for the incumbents.
That's Vishy Tirupattur and Peter Cheer. Thank you so much for your time. Still ahead, we have the final spread, the big week ahead. It's big banks kicking off earnings season. I am going to have a huge week. Come join us. This is Real Yields on Bloomberg.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values, and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States, and everywhere. What did TikTok do that enabled a Chinese-based company parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
I'm Shonali Bassick, and this is Bloomberg's Real Yield. Time now for the final spread. The week ahead coming up, more Fed speak Monday from Bard, Daly, Mester, and Bostic. The 74th NATO summit begins on Tuesday. Wednesday, we'll get U.S. June CPI data ahead of PPI data, jobless claims on Thursday, and rounding out the week Friday with UMISH sentiment and the start of a massive earnings season. Big banks will be leading the way, and it's important to keep an eye on them. We have Wells Fargo, Citigroup, JP Morgan all starting next Friday. Remember, we'll be watching for loan quality, any deterioration, net interest income expectations. We're going to see what those Fed hikes really mean for the biggest banks in the country. We'll be watching for the regionals as well, but also Bank of America, Morgan Stanley, Goldman Sachs, how the investment banks are faring for this higher for longer cycle. And from New York, that does it from us. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.
Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it, and this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president is calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy, but man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
I'm John Olackerman, and welcome to Bloomberg Markets.
And I'm Matt Miller. Let's get a quick check on what's going on in the markets at this hour. We're looking at some gains that are pretty decent. After a miss on the jobs report, you would have expected stocks to rally maybe a little bit more than this, but we're still up about 2/3% at 44.40 on the S&P 500. You also see yields hanging pretty much where they were, a little bit over 4 on the 10-year. The 2-year had been over 5 and come back down a little bit. It's hanging around that level right now. You can see the Bloomberg U.S. dollar index down almost 1% right now at 12.25, though still I think the strength that we've seen this year has been surprising to most, or would have been if you'd told them that at the beginning of the year. And there you see NYMEX crude. That is not Brent. Up $1.61 at 73.41. So crude finally gaining a little bit of ground here, at least in New York. John?
Helping energy stocks up north as well. Actually, a complicated day here in Canada, Matt, because the market is rallying based on that U.S. jobs report. But we did have a stronger than expected jobs report for the month of June in Canada. 60,000 positions created. That was triple what economists were predicting. You did see the unemployment rate tick higher at 5.4%. But, Matt, we've got an interest rate decision for Canada next week. And most of the big banks are now expecting that once again we'll see another interest rate hike, likely a 25 basis point move by the Bank of Canada.
All right, so 2 jobs reports on this continent today. Let's focus in on the U.S. right now because it's likely to keep the Fed on track to raise interest rates this month. Here's how BlackRock's Rick Reeder interpreted the data.
It's a solid report, though. I mean, yes, it was a little softer on the headline, but the wages were up, the work week was up. And, I mean, you're operating at 3.6% unemployment rate. We just had claims data that continues to show that labor's in good shape. JOLTS data was a little bit encouraging, and that private hiring was coming down a little bit. But, boy, you're still talking about a lot of jobs open. So, anyway, I think it's, I think you got to parse it quite finely to say it's softer. I mean, it's solid. I mean, the economy is solid, and employment data is solid.
Okay, let's get some more perspective. We've got a great roundtable for you. Liz McCormick joining us along with Mike McKee. And Mike, let's start, I guess, with some of the more specifics here. We just heard sort of the reaction there, but what were some of the takeaways as you look deeper into this jobs report?
Well, I think the basis for everybody examining this is what is it going to do for the Fed, or what is the Fed going to do with it? And 209,000 is still more than twice what you need in terms of job creation to absorb all the new entrants to the labor force. So this is still a strong number. Maybe we got a little bit off track thinking about what ADP did yesterday, but 209 is still a strong number. Then, as Rick Reeder was noting, the unemployment rate goes down to 3.6%, and the Fed is forecasting by the end of the year will be at 4.1%. More jobs created in the household survey, and more jobs lost, fewer jobs lost. So you're seeing strength in both aspects of that, and so you're still seeing strength in wages. 4.4% annual rate is about a percentage point above where the Fed thinks it needs to be. So until we see something happen with wages, until we see the economy slow in terms of job creation, the Fed is going to be on track to raise rates.
And Liz, as you sample what the street's interpretation of all this is, at what point, even if some see more rate hikes as justified, do more rate hikes start to be viewed more as a risk?
Yeah, it's funny, Johnny, you bring that up because I had one trader say to me today, yeah, the Fed's going to hike again in July, which seems to be the norm. And he's saying that's a mistake. They're going too far, that things are starting to turn, albeit slowly. So I think you're right. There are people saying that, this 500 basis points already in the system, those long and variable lags, that we're going to feel more pain. But I think, the general view is the Fed is going to go again. And it seems to me we're already jumping over July. The question is what happens after that? We don't have another meeting until September. We have Jackson Hole. So I feel like it's a long few months of volatility ahead.
Yeah, I was going to ask what you're watching for next, Liz. Of course, we have CPI coming out next week, and I know that Mike is jetting off to Jackson Hole. So there's a lot to watch. What's the most important for the Fed?
Yeah, for us in the bond market, it's the CPI next week. I mean, there's other data and other things, but like I saw the Fed's Austin Goolsbee was on the tape today saying we have a chance of this kind of, he didn't say Goldilocks, but golden something like a soft landing. And I think if CPI comes down, I think the July thing is going to happen, the hike. But I think that's going to build this kind of feeling that maybe they're going to be able to pull this off to slow inflation without crushing the economy. I know others think a recession is coming, but we haven't seen it yet, right?
Well, and obviously...
Sorry, John.
Yeah, go ahead, Matt.
You know, a lot of people have said or have been saying, I think Ed Hyman was saying for a while that we are in a recession. We just don't know it yet. Now he's saying the data is worse than he's ever seen it without being in a recession. But we would really have to lose a lot of jobs, Mike, wouldn't we, in order to get into a situation where the NEBR would consider us in a recession?
Yeah, and we would have to see a lot of things change, including business spending really fall off and consumer spending really fall off, neither of which is happening. And so the markers that the NBER uses to set up a recession, they're not there yet. But this is a very, very divided economic community and bond market because there are about half the people who think we are going to go into recession and that the Fed is going to go too far. And there's another half that think the Fed is on track maybe now to land that plane softly. And one of the things that's going to be interesting next week, you asked about next week, is there's a lot of Fed speak next week. And we heard Goolsbee today. Yesterday, we heard from the Dallas Fed president that she thinks that lags are not there. What's been done has hit the economy already, and so therefore they need to raise rates even further. So will they do that or not is an interesting question, and I think Liz is right that it's now about September. They'll price in July as a done deal, and then we'll see what happens with September, whether they go two in a row or whether they go back to pausing for a month.
And Liz, I guess when we're taking the temperature of the kind of bonds that investors are curious about right now, like I was talking to the veteran economist David Rosenberg yesterday, who at this point is thinking go longer duration. And obviously we talked about the challenges for that longer duration debt, but what kind of bets are traders willing to make right now?
Yeah, that's what I'm hearing too, that people are extending duration because, you know, front end rates are really high. We saw twos go over 5%, of course, but, you know, the Fed could go a little more. And, you know, the real bang for your buck, if things start to unravel and we finally have stocks coming off and risky assets overall getting a hit, you know, that's where the long end is going to work. I mean, I know last year we had the anomaly of stocks and bonds both down, but people feel like rates are high and good to lock in. Plus, they're going to work again as the ballast in your portfolio. So that's what I hear too, John, that people are kind of leaning long, avoiding the short end, and hoping that, you know, not that things unravel, but that the long end bonds prove to either be a great coupon, which they are better than they have been in years, and they might work if things unravel. They'll go up if stocks go down. So that's kind of the tone of a lot of investors now.
By the way, Goolsbee said we're on a golden path. That's the golden point that Austin Goolsbee was making, that the Fed could ease price growth without triggering a recession. Obviously, soft landing is the term most of us use, but Mike, I heard yesterday Mark Zandi was saying he prefers the term slow session. He's even bought, I think, the URL for that, which is interesting, from Moody's. What do you think the chances are that the Fed lands us nice and gently?
Liz and I are going to have to get the T-shirt concession for that. I think the chances have improved. Part of it is how you define a soft landing and at what point you do, because the economy never really lands. It always keeps going. But if they can get inflation down without a recession, you would probably call that a soft landing.
All right. Mike McKee, thanks very much. Our chief international economics and politics correspondent. Liz McCormick there watches the bond market for us, as well as the entire macro picture for Bloomberg News. Thanks so much for joining us. Now, one part of the jobs report that stood out to me was the leisure and hospitality sector. Yesterday's ADP June jobs number showed a huge surge. But today, the industry in the NFP report showed only 21,000 jobs were added. That's pretty meager compared to what we've seen over the past, 14 months. Let's get a first-person perspective with Carolyn Stein right now. She is co-founder of the Loop Group and a founding member of the independent restaurant coalition. So, Carolyn, still seeing some growth, right? And, you know, your industry was hit the hardest, really, during the pandemic shutdown. You've come roaring back in some ways. What's the situation like right now?
Well, thank you for having me. It's definitely a mixed bag, yes. I mean, obviously, we suffered such great losses during the pandemic that, thank the Lord, we're actually building back, and we're really happy to see that small businesses and small restaurants are benefiting from that. But we're definitely in a balancing act right now, trying to deal with these, as you're talking about the rate hikes and how that affects our business and how it affects how we have to, you know, handle wage increases. And, you know, I think some places are busy right now. Some resort areas are probably are hiring seasonally, but overall, it's been a really soft summer for restaurants.
Well, and I also think back to the pandemic, Carolyn, and the fact that so many restaurant operators, if they could stay afloat, they had to find ways to stay afloat, taking on debt. And I wonder how they're still navigating, even if they're getting back to business, some of the headaches that they had to take on a couple of years ago.
Yeah, that's a really, really good point, because we are all still digging out from that. We all suffered so hard financially. We went into deep loss, deep debt. And yes, it seems on the surface like people are going out, restaurants are full again, but we're so far down in the hole that it's been a really precarious climb out. And I think there are very few that are really, really thriving right now, especially within the increase of costs and the increase in wages for sure.
So what would be your, I mean, we're here talking about what the Fed might do next and whether a resilient job market justifies more rate hikes. What would be your message to Washington?
My message would be, please stop. every time the Fed meets, you know, we restaurateurs start sweating, because I know they're trying to tamp down wage increases, but we are sort of stuck in the middle. We have cities that are instituting wage hikes that we have to keep up with. We also are sort of challenged to keep our employees making a living wage, and you know, still hard to hire people. So if you're not offering a living wage, then you can't hire. I know many restaurants that still aren't open for all of their services because they can't bring on enough employees. And especially when you're having a soft summer and our wages are increasing outside of our own control, it makes it impossible, really. So please stop.
Yeah. I mean, Carolyn, they're also trying to, you know, eventually tamp down food inflation, which has been huge, right? I mean, I don't know exactly what you're serving, but if I look at cattle prices this year, they're up 35%. And across the ag space, we've seen incredible inflation. For the most part, I know egg prices came down substantially, but then they were up so high. How are you dealing with that kind of inflation on your menu?
Well, and that's the thing. We all need to increase our menu prices dramatically, and we're holding off as long as we can. We understand that customer sentiment really drives people's desire to go out and where they will go. And if you price your menu too high, then you lose your customers. And at the same time, all of those costs are up. And so it makes it even more precarious. And the restaurant industry, I think we've told everybody over the last 3 years, is notorious for very, very thin profit margins. So all these increases are making it more and more difficult to even break even. Yep. But yes, it's all about menu increases, unfortunately.
How is, from your perspective, Carolyn, at the Loop Group, the consumer holding up? Is the consumer still, you know, going out to dinner on a regular basis, still ordering, you know, the pricey pieces on the menu, still, you know, drinking as much as possible? What's it look like?
You know, that's a mixed bag, too. You know, there are always those people who will still spend, but I think generally people are being more choosy about going out. I think people get scared off by these rate hikes too, and I know every time I see an increase, our reservations drop off a little bit. I think people get very scared financially, and they think, oh, do I need to spend that money tonight on dinner? Maybe not.
Carolyn, as much as we talk about these headwinds, you yourself are an extremely successful entrepreneur. And as people get into this business or they're navigating through this business, what would be your piece of advice on things they should be thinking about going forward?
Oh, my. Whenever people tell me they want to get in the restaurant industry, I talk them out of it. But, you know, you just have to be really, really well-funded. You cannot open a restaurant and without having enough capital. So that's really vital. Being very cautious about spending. And, we've been saying this forever, but 97 cents of every dollar that comes into the restaurant goes out immediately into the local economy, but also just towards all of those costs. So you have to be really ready to be very fiscally responsible and tight. I really think it's important to have a vision and have your point of view, because it's all about setting yourself apart from everybody else. And people are really, really choosy now and really sophisticated in terms of where they're going to dine. So you really need to hit it out of the ballpark with your food and your hospitality and the experience you provide.
All right, well, Carolyn, we're really glad to get your insight. Really appreciate you spending some time with us. Carolyn Stein there, founder of the Loop Group, talking to us about the restaurant industry. Coming up, a nearly $1 billion fine for Alibaba could pave the way for an IPO of Ant Group, and so the shares are soaring. This is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. Yeah. There's nothing closer than the phone in your hand.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
This is Bloomberg Markets. I'm John Olifant with Matt Miller. Time now for our stock of the hour, and it's Alibaba, which has been on the move today, having its best day since March. This comes after China imposed more than $1 billion in fines on Ant Group and Tencent. Alibaba owns a third of Ant Group, which is a fintech player. Now, that might seem like a negative, but the market sees this as a potential end to a crackdown on China's tech sector. Regulators had ended Ant's IPO plan after Alibaba founder Jack Ma angered Beijing by calling out financial regulators. So, Matt, this is viewed as a potentially new path for growth for Ant and a possible chance to revive the IPO plan.
Yeah, absolutely, and a huge jump there. We'll be watching the Chinese dragons, as they're called, Chinese companies that trade here in the U.S. very closely today and next week to see if this really marks a return. We've already seen Jack Ma, pictures of him, back at the office after he kind of disappeared for a while. And now that we get the possibility, the potential of an Ant IPO again, that would be very good news for the sector, even at a time when China is having a difficult time economically.
Well, I mean, you've seen all these U.S. tech stocks surge, but Alibaba is still well below, for example, its peak in 2020. So we'll see if the tone changes in the second half of this year for Chinese tech stocks, Matt. Meanwhile, coming up, how much would you pay for a career coach to help you land a fully remote job? Well, we're going to get the numbers on that. This is Bloomberg.
In climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. We're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Only on Bloomberg TV and radio.
This is Bloomberg Markets. I'm John Olifant with Matt Miller. Time now for today's For What It's Worth. How about $3,000? That's how much it can cost if you want to land a work-from-home job. There are very specific career coaches now charging that sum for people who want remote gigs, which, Matt, they've become a lot harder to get post-pandemic, and so everybody's interested in some cases, taking on a coach.
Yeah, absolutely. Let's bring in right now Jo Constance. She's the reporter who wrote the story today. And Jo, I saw that, more than half of the people looking for a job want full-time remote work, but only, I think, 11% of the postings are for that kind of position. So how much longer do you think this incredible demand is going to last?
You know, that's a great question. We saw in 2022, that's when the demand really peaked. Over 50% of applications were fully remote roles, but the supply was a little bit better. It was closer to 20% or even over 20%. And it's, you know, come down a little bit. It's now under 50% of applications are for fully remote roles, but it's still up there, even though the supply has really come down quite a bit to, as you said, around 11%. So I could see it hovering there for a while until people realize, yeah, this is really just not going to happen, or it's not very realistic for most people.
And Joe, what I loved about your story is it just highlights, if we're talking remote work, you know, there might be people all over the world that are trying to get the same gig. So that's why, as you point out in your story, maybe you get a little help. But also the fact that sometimes there are some too good to be true listings out there that turn out to be just that.
Exactly. Yeah, that's a huge thing that some of these remote job coaches are looking out for, is the fact that some of these jobs, you know, it's easy to get somebody to give over some personal information because it sounds great, you know, just getting paid a ton of money to sit at home and do that whole thing. But so you have to be wary of that. But right, you know, the demand is so intense. Sometimes listings will go up, thousands of applications will be submitted, and then it'll be taken down in 24 hours. So it is very competitive out there.
So you focus on, at least in the lead, a job coach, Darren Cronian, helping people for what, $3,000? That's the fee. What's his success rate?
Well, Darren, yeah, so he was really frank with me. He said, you know, earlier on last year, again, there were more remote jobs available, and his success rate was about 80%, just, you know, going through the basics, having people do best practices in terms of, you know, tailoring their application for the role, those sorts of things, just, you know, the essentials. But now he said the competition has gotten a lot fiercer, and it's kind of fallen down to like 60%, he said, are getting jobs when they're working with him. And, you know, a lot of people are getting really frustrated.
All right, great story, Joe. I recommend people check it out on the terminal. Joe Constance there wrote the story about a $3,000 job coach who can help you maybe get a fully remote sweet gig. John, we're looking at gains still on the S&P 500, more than 0.5%, so not making back what we lost yesterday, but it looks like the markets generally like today's non-farm payrolls number.
Exactly. So we'll continue to watch this market action as we move towards the closing bells on this Friday. For Matt Miller, I'm John Ehrlichman. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about, like, how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Bloomberg Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
No rest for the weary. Live from Studio 2 at Bloomberg headquarters here in New York, Romaine Bostic kicking you off to the close here on a Friday afternoon. A bit of a dip buying as we head into the weekend. That's leading to some modest gains here on the day for the S&P 500, though we should point out, not enough to erase modest losses for this holiday shortened week. Energy, materials, and discretionary stocks leading gains on this Friday. Schlumberger, Halliburton, Mosaic, First Solar. Those are your big percent gainers here on the day, while big pharma names like Merck, Biogen, Lilly are your biggest laggards. The VIX, which broke above 17 yesterday, back down below 15 today. And the seesaw week that we see for the Bloomberg Dollar Spot Index, that continues. Worst day for that index going back to at least February. The yen posting its strongest advance versus the dollar going back to early May. As for treasuries, also another topsy-turvy day for them, with investors buying on the short end of the curve and selling on the long. The 10-year yield right now pinned just around that 4% mark. Your 2-year yield slips a tad below 5%. Now, much of the price action this afternoon was spurred by that jobs report this morning. A slower pace of employment growth, but a pace that still represents resiliency. Non-farm payrolls increasing by 209,000 in June. The unemployment rate falling to 3.6%. Average hourly earnings rising 4.4% from a year earlier. That's the good news. Now the bad. Take a look at the board behind me, because those 209,000 jobs that we added in June, that was the smallest going back to the end of 2020. The strong labor market results for April and May, those were revised downward. And the hiring that is happening of late, at least, well, it's been increasingly becoming concentrated in just a handful of sectors. There's a payroll diffusion index that has largely reverted back to those pre-pandemic levels after peaking in February of 2022. Now, you put it all together and it provides no real relief for bond traders, no real green or red light for equity bulls, and Abigail Doolittle, maybe no real reason for the Fed to keep its rate hiking cycle on pause.
Yeah, you know, Romaine, that is definitely the case, because we have the economy decent. I think that if you listen to the Fed on the one hand, the markets on the other hand, the Fed has been right in terms of what they've been messaging about hiking. But where they both agree is July, because Fed Chair Jay Powell at the last meeting did say July is live. That wasn't a firm accommodation in terms of a hike is for sure, but markets are taking it. That's pretty likely that we're almost right there at one hike for the July meeting. But the second hike, and some Fed officials have been talking about the possibility that there could be a second hike, that's the bigger question. So we can ask ourselves, is the Fed's job done? And of course, Romaine, you're just going through all that data. If we take a look at PCE, which of course is their preferred look at inflation, because at the end of the day, I would argue one of the big reasons for the beginning of the hiking cycle, inflation, especially in the housing market. So the housing market has cooled off, but so has PCE. The last reading in May was 4.6%, and here is the jobs market. So they seem to be succeeding. Now, is it stubbornly high? Yeah, it's kind of flatlining up there, but it is again moving in the right direction, as is jobs in terms of the Achilles heel to this hiking cycle, Romaine. That said, I would suggest that they probably want to see PCE go back toward their goal of 2%. So when they say that they might not be seeing cuts for years, well, I would probably put my bets on the Fed.
Yeah, absolutely. Betting against the Fed has certainly been wrong over the past few months. Whether that changes over the months ahead remains to be seen. Joe Davis joining us right now. He's Vanguard's global chief economist and global head of investment strategy, as we kick you off to the close here on this Friday. And Joe, you take a look at that economic data that we got this morning. I guess some of the economic data we got over the last couple of days here, and that seems to be the ammunition that I think Jay Powell would want to see to keep hiking interest rates.
Well, certainly, and I think what we're seeing is just continued momentum in the economy. I think some of this was just the echo waves of the pent-up demand. We see that in parts of housing, we see that in the auto and the consumer sector, but it's clear that the labor market is cooling. I think the big question is how much does it need to loosen? Because if it does not loosen a little bit, we're still going to have an inflation problem at year end.
Why do you think, Joe, that we haven't seen much more looseness in the labor market, given just how aggressive the Fed has been, and for that matter, just kind of the withdrawal, or at least I guess the pause, if you will, of other forms of stimulus coming out of the fiscal side of the equation?
It's a great question. I think ultimately I would bottom line it to say that the Federal Reserve, despite being very aggressive, is not that restrictive. They only have the Fed funds rate. Yes, it's above the rate of inflation, but it's not 200 or 300 basis points like we've seen before recessions. And I don't even have to make an argument that our star is higher, which it very likely is. So I think it will take time. The labor market is cooling, so that's a positive. But nevertheless, you still have a material imbalance in labor supply and labor demand. And I think it's naive to expect that we're going to see a magic fall in wages without some further tightening the Federal Reserve is going to have to do.
We have started to see, I guess, some softness in consumer spending. I know there's been we've talked a lot about that rotation into services and other things, but some of the recent reports we've gotten seem to suggest that maybe we're not as spend crazy as we were maybe a year or so ago.
Certainly. I mean, I think we're still seeing some of that rebalancing out of the goods into the services, travel, leisure, and so forth. That will continue to work its way through the system. But, generally speaking, consumer activity is not a leading indicator. I know it's 70% plus of the economy, but it comes down to business investment, which is then tied to the job growth, and then that ultimately drives income and consumption. So really, if businesses continue to expect very strong demand, then they're going to continue to hire. And so I have not seen that dynamic shift, and that's why we've seen the Federal Reserve terminal rate continue to rise over the past year and a half. And I don't think they're fully done. I'm not saying they're well behind the curve. I think we're getting closer to the end of the tightening cycle. But I don't think the Fed cannot claim that they are very restrictive, because it's just simply not true when you look at relative to inflation.
And we've heard that from some Fed members, and I think the Fed minutes sort of revealed that discussion behind closed doors. Of course, looking forward, as you know, Joe, we get the Fed meeting, the Fed decision, I should say, on the 26th of this month. The next one is in mid-September. Then, of course, in between that, you get Jackson Hole. What type of communication do you think we're going to get over that stretch? Do you think it's going to be as unified as it was over the past year?
I think so. I mean, again, central banking is also a really tough job, and so they are trying to be forward-looking. At the same time, they know that some of the indicators that are the strongest in the economy give you very little lead time before a recession or even a material slowdown. Consumer spending, jobs market, they actually don't lead the business cycle, and so I think they're trying to talk to businesses. They're trying to calibrate. They're looking at the financial markets and inflation expectations. I think that all leads them to some more modest tightening ahead, and then at that point, it's going to be to see, how much still imbalance do we have in the labor market. If we do not see some of the vacancies come off, then we're going to have an issue in 2024 in terms of still elevated wage growth.
All right, Joe, always great to catch up with you. Joe Davis there, Global Chief Economist and Head of Investment Strategy over at Vanguard, giving us his take here on the economic data we got this morning and a big Fed decision coming up in about 3 weeks' time. Let's keep the conversation going now and get a perspective from an investor. Max Gauckman joining us right now. He's Senior Vice President over at Franklin Templeton Investment Solutions. And Max, I am curious as to whether you think this is still a market that is kind of beholden to the macro, beholden to the Fed, and beholden to the economic data that they say that they're still dependent on.
The market is always beholden to the Fed and to the economic data, Romain. I think what it sometimes doesn't do a good job of is actually listening at the same time as the Fed is speaking. So there's a bit of a lagged effect. But I think what we're going to see is that catch up with equities. And by the way, if you look at real two-year yields, we're seeing the bond market pricing in this reality a lot more. So it's just a question of when does equity catch up?
Well, I guess I would ask you that question, Max. When do you think equity catches up?
Well, we've already seen margins deteriorating quite a bit. I believe it's about 8% year over year, but we haven't seen sales come down yet, and margins do lead sales. So I think this quarter is going to be fairly critical for that bearish thesis. And I do believe that we're going to start seeing sales declines come through in this reporting season.
When we start getting into this earnings season, because there's been so much talk, Max, and I'm sure you've seen the big run-up in share prices, particularly amongst the tech stocks, but even some of the other names have started to participate in this. And there has been some concern here about the multiples now that you see on these stocks and whether we get the earnings fundamentals to actually back up some of those multiples. Are you optimistic?
I don't think we're going to see the fundamentals back up. I think what we actually need to see is pretty significant multiple compression. Valuations are extraordinarily high. I think within tech especially, the investor thesis seems to be that if you append GPT to whatever you're doing, you automatically get a big price multiple boost. And that, unfortunately, is just not how AI works. It's a technology that I'm extremely bullish on. But it is something where if you believe that simply adding AI to your lineup magically increases your revenue, then you are hallucinating harder than a large language model trained exclusively on 80s sci-fi flicks.
All right. Well, a lot of people are chasing it, Max. I mean, they see at least maybe the potential for some sort of structural changes there. For those investors who maybe come to you and they say, do you chase after this sort of AI hype here? Do you find some substance there that maybe gives you some confidence to say, yeah, maybe you do put a little bit of money into it?
I think you need to be really selective at this stage, and there's three things that I want to touch on. One, look for very clearly defined enterprise use cases. So if the data is really clean, really well structured, and there's a clear need, so if you're not a solution looking for a problem, then that makes sense. If you're a consumer-focused technology company and you're using AI to rapidly, in fact, real-time predict future consumer behavior and then deliver deeply personalized solutions, there's a there as well. In fact, this is one of the reasons we've seen the search words reignited, but as with all wars, keep in mind there's going to be winners and there's going to be losers. And lastly, as in the early days of crypto, think about the picks and shovels, which in this case I would say are the semis and the cloud infrastructure providers. And that's also where I see opportunity.
All right, Max, going to have to leave it there. Great conversation. Max Gauckman-Barry, Senior Vice President over at Franklin Templeton Investment Solutions. We're just getting started here. A lot more to talk about, including that $1 billion fine for Ant Group, maybe potentially signaling the end of China's crackdown on the tech sector, what it could mean for Ant's IPO plans, what it could mean for investors. Plus, staying over in Asia, Samsung reporting its worst decline in quarterly revenue in more than a decade, but the results suggest potentially that the worst might actually be over for the memory chip sector. An explanation coming up in just a bit, and Apple planning a slow rollout of that $3,500 Vision Pro headset. We've got details of Apple's strategy. All that and more coming up in just a bit. This is Bloomberg.
Replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customers like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Big moves in shares and ADRs of Chinese stocks. Alibaba soaring today. China actually finally imposing those fines on the affiliate Ant Group, providing a little bit more clarity for investors going forward. Also fines announced for 10 cents as well. The move signaling an end to a tech sector crackdown that had wiped out billions in market value and, of course, derailed what would have been the world's biggest initial public offering. Isabel Lee joining us right now, Bloomberg cross-asset reporter, to talk about some of these moves. And investors seem to be taking this as kind of the all clear.
Yes, it's kind of counterintuitive. Because 1 billion, yes, maybe it's a big number, but not really for a company like Ant and other major tech giants. But it's the all clear. We know that China has gone through this multi-year crackdown on tech companies, leading some of Wall Street's biggest firm to call it uninvestable. But now it's like, okay, maybe the coast is clear. We can now just move forward.
Is there, I know it's always hard to sort of get a read on what the Chinese government will do next. But, of course, the big question that every investor has right now is, does this mean that that big Ant Group IPO that everybody was anticipating in a couple of years, is that potentially back on?
That is the hope, but if we look at the technical rules and everything, they cannot list in Chinese A share, so-called, because that would require 3 years of no change in leadership. 2 years for the Shanghai Star Market and 1 year for Hong Kong Stock Exchange. But still, hopes are still there. But if anything, this will not be back to the 280 billion pre-IPO valuation that Ant had when it was 2020, because their bottom line isn't doing good. Their December quarter earnings plummeted 56%. So it's a much different picture. In fact, the story said it's now more fin than fintech.
That's an interesting comment there. I am curious here, when we talk about the regulatory overhang and what other additional pressures could come on these companies, do you think investors can have confidence that there has been a material shift in how China views these companies, and more importantly, how it deals with them?
I think confidence is kind of slowly creeping in, and the Chinese government is aware of that, which is why they asked Jack Ma to come back in March after years, not years, months of prolonged stay overseas. They asked him to come back to show commitment, to show that, you know, it's a new shift, a new tone, and he did come back, and that's after in January he ceded control in Ant. So that there's kind of that, and a lot of people now are kind of betting on China. I mean, the reopening didn't happen. It wasn't a boom as we hoped, but at least there's kind of more optimism in the area.
All right, Isabel Lee with a look here at some of the ADRs moving here in the U.S. Alibaba up about 9% on the day. JD up about 6%, even Tencent holding, moving up by about 4 to 5% here on the day. Meanwhile, of course, while all that was going on, the Treasury Secretary of the United States was meeting with top officials in Beijing, aiming to find some sort of common ground between the two superpowers.
I've made clear that the United States does not seek a wholesale separation of our economies. We seek to diversify and not to decouple. A decoupling of the world's two largest economies would be destabilizing for the global economy, and it would be virtually impossible to undertake.
The U.S. Treasury Secretary in her very measured comments there in Beijing as she continues that trip. Let's go down to Washington, where Kayleigh Lyons, the co-host of Balance of Power, is standing by. Unfortunately, Kayleigh, you did not get the trip to Beijing, but I'm sure you were listening in on what Yellen had to say here. What were the takeaways from her first full day there on the ground?
Well, in many senses, Romaine, this is a repeating of the line we've continually heard from the Treasury Department and just the broader Biden administration, that this is about diversification, not decoupling. And the Treasury Secretary went on to say at this meeting with China's Premier Li Qiang, basically that they are trying to have healthy competition. This isn't a winner-take-all kind of scenario. That said, they are, of course, trying to narrowly target their strategy and in response here to protect U.S. national security interests. But ultimately, Yellen says she wants to keep this conversation going. That conversation today, we understand, according to a Treasury Department readout, did mean she raised some issues of concern. She expressed concern specifically about the metals curbs that China put into place on two very strategically important metals, gallium and germanium, just days before she touched down in Beijing, because, of course, the backdrop to her trip here is this constant tit-for-tat on trade between these two largest economies. You have the metals move from China at the same time that the U.S. is looking at restricting cloud.
And then there was a report overnight here that U.S. officials have actually sort of renewed or refreshed their auditing inspections of Chinese firms. What's that about?
Well, we know there's been a lot of debate back and forth about the auditing of these big Chinese technology companies, largely that are listed here in the U.S. And there was the threat overhanging for much of last year that they could actually get kicked off of U.S. exchanges. Of course, an auditing agreement ultimately was come to, and that's really what part of this is. We understand, according to Bloomberg's reporting, via sources familiar with the matter, that the Public Accounting Oversight Board, Public Company Accounting Oversight Board, did send people to Hong Kong last month to review some of these biggest companies. Think Tencent, Didi, NetEase, all of these at play here, looking at their audits for 2022, and that really just kind of underscores the ongoing tension and trust issues, perhaps, between the U.S. and Beijing.
Well, I have to ask you, though, Kayleigh, here. I mean, we're on a day where we're seeing some optimism in Chinese ADRs here in the U.S. We also had the report here that there had been a little bit of a pushback against some analysts over at Goldman Sachs who had came out with a recommendation kind of talking down Chinese bank stocks. And this raises a big question for investors is how much freedom and insight do you have to really make objective comments about what's going on in that country?
It really underscores the difficulty for Wall Street banks, for example, on navigating this market. That Goldman note you alluded to came out on Tuesday, basically expressing some hesitation around certain regional bank stocks, and it was actually refuted by a Chinese state-owned newspaper, the Securities Times, that basically said the market shouldn't be taking a bearish view on some of these Chinese banks because of pessimism that is out there, talking about how they've made attempts to hedge risk when it relates to real estate and property loan risk, for example. So that also kind of puts an emphasis on what seems to be Beijing's concern about market sentiment as they are dealing with a much more fragile and weaker economy than many had anticipated. Clearly, they are trying to continue support for the markets and not want to feed into any kind of fear that investors may have.
Kelly Lyons down there in Washington, keeping an eye on Janet Yellen as she makes her way through China on this trip to maybe potentially mend relations. We're going to stay over in Asia because there were earnings out of a big behemoth of a company in Korea. Samsung did report its worst decline in quarterly revenue in more than a decade. There are a lot of questions, though, about what this actually signals for the chip industry. Some say, well, it could be a bit contrarian. Maybe we've reached a bottom. That conversation coming up after the break. This is Bloomberg.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, is all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Keep an eye on Samsung. Those shares over in Seoul, Korea did fall a little bit earlier today after the company reported its worst decline in quarterly sales in more than a decade. Some concern now here about the health of the semiconductor industry. Bloomberg Technology co-host Ed Ludlow all over this story. And Ed, let's start here actually with the contrarian side of this, because there were some people that looked at this and said, maybe this is a sign that, well, the next move has to be up.
Yeah, there's mixed feeling about the health of the market. I do want to quickly correct something we said on Bloomberg Technology earlier, which is that Samsung's quarterly revenue fell by $46 billion. What we meant to say, of course, was that it fell to $46 billion, which is a 22% decline in quarterly revenue, as you point out, the steepest since 2009. The story's the same. For memory, DRAM and NAND, broadly, the demand is not there for chips, and we know that electronics companies, the end product manufacturers, have been going through big inventories because of the mismanagement of the supply chain during the COVID era. And the street's kind of split because you're right, Micron, SK Hynix, the kind of two competitors of Samsung in the memory space, have given us signals that we have hit the bottom. We don't necessarily see that with Samsung on the top line, but on the bottom line, there is some more interesting story there.
Oh, well, talk about what that interesting story is, though, too, because, I mean, we know that, at least when it comes to memory chips in and of themselves, that's a pretty cyclical business, and it always has been. But this is a company that gets a lot more money from things other than just memory chips.
Yeah, it's cyclical and commoditized. And so that's why we go to the bottom line, because even though operating profit fell by 96%, that end number was still better than the street expected. And what we think that represents is Samsung shipping DDR5, and DDR5 stands for double data rate 5. It is a higher end next gen DRAM chip, which works well in the AI context. So you think about the GPUs we've been talking about, the H100s from NVIDIA as an example. They all go into a board, into a stack, into a server, into a data center, but you need to have the memory capacity, both DRAM and NAND, to handle the data, to store it and process it alongside that. So there is evidence they were able to ship some of those higher value, higher ASP AI memory chips in the quarter.
Yeah.
But there is a disconnect. Like, there's huge demand on the GPU side. When do we see that huge demand for the memory that supports it come through?
All right, Ed Ludlow, of course, Bloomberg Technology co-host, him and Caroline Hyde. You can check them out every day at noon New York time, right here on Bloomberg Television. Meanwhile, back here in the U.S., a modest rally on our hands here for the day. Not necessarily enough to erase the modest losses on the week, but I think some investors will take it. The Philadelphia Semiconductor Index is your outperformer, up more than 1% on the day, led partly by gains from NVIDIA, up 2.5%. The NASDAQ 100 up about 0.6%, but your big outperformer, that belongs to the Russell, cyclical stocks, up almost 2%.
crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Three prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Markets to close, almost 2:30 here in New York. Another wild day in equity markets, another wild day in treasuries. But let's get a check on what's going on with commodities and our commodity close. And Abigail Doolittle. Abigail.
And overall, we have strength, Romaine. And you can see New York crude right now up 2.9%, really a nice gain at $73, almost $74 per barrel. Silver also up 1.8%. Now, I would argue that the strength for these two commodities and commodities overall in the day, the dollar, which I think we might be taking a look at in just a moment. Corn and soybeans, though, not so much. Wheat is down a little bit, too. Some serious declines here. Corn almost down 2%, and then soybeans down by 1.5%. I'm thinking that has to do with weather. But as for the dollar, right now on the day, it is down 0.7%. This after we had that mixed jobs report. That's sending the dollar lower. That's the worst day since February 1st of this year. And, of course, when the dollar is lower, that is going to give a lift to risk assets denominated in dollars if the overall macro is seen as okay. So right now, again, we have commodities overall higher. We also have stocks higher.
All right, our thanks there to Abigail Doolittle. A nice wrap up here of some of the things that have been moving the market. We should point out commodities as a close here. You look at the Bloomberg Commodity Index, actually going to post what is going to be its first weekly gain that we've seen in about 2. And in fact, when you look at sort of the energy and how it's led the charge and whether you get some maybe catch up in that space as well as with some of the industrial metals, of course, a lot of that will depend here on economic conditions. That, of course, has been a big part of the discussion this week with the big jobs report this morning. And, of course, we head into next week, and it's going to be a big one. We get the CPI report in the middle of the week, and then towards the end, we head into earnings and that big Fed meeting for a little bit further out towards the end of July. Of course, the market sentiment right now, maybe, just maybe, actually maybe shifting just a little bit here. It's been an awful first half of the year when it comes to deals, whether we're talking about M&A or IPOs, but starting to see a little bit of a pickup in IPO activity. Remember that big Kava IPO? Yeah, it actually did pretty well, and now Bloomberg is learning that private equity firms are considering options to bring Birkenstock public. That could be a $6 billion IPO. Bloomberg's Crystal C joining us right now to talk a little bit more about this. $6 billion for Birkenstocks?
Well, over $6 billion.
Oh, over
for
6
Birkenstocks.
I stand corrected. I mean, I know they're popular, right? And this was a company that was taken private or taken over by private equity, I should say, just a couple of years ago, right?
That's right. It's a little bit over 2 years ago. Al Catterton beat out CVC, another private equity firm, to take the company into the private equity's hand. The company's family, the two brothers, Birkenstock Brothers actually retain a minority stake.
Okay.
And it's
Wait,
very...
so there's actually a Birkenstock.
There is a
Okay,
Birkenstock
I'm learning
family.
a lot here. Go ahead.
And they're all in Germany. This is this has become a global product. It's not just for every day. They're having very high fashion luxury collaborations with Dior, with Valentino. It's an exciting story, not just...
I bought one. You know, I never owned a pair of Birkenstocks until this year, and I
Birkenstock?
bought they had some collab with Todd Snyder, and my wife was like, "You should get these." So
Todd
I'm on
Snyder is
board.
very cool.
Yeah. So anyway, not to throw you all off track here, but I am curious about what this says just about, and I know that this is probably the time frame for this isn't happening tomorrow, right? This is maybe a year out. Is that the idea?
Yeah, so like any IPO, it takes a long time to prepare. We're learning that it will either be later this year or sometime next year, which is actually a good thing. You know, IPO market really comes and goes, and for a company to prepare for an IPO right now, it doesn't mean that they tap the market right now. But like you said, currently the IPO market is not that bad. Kava went public, raising $366 million, and it actually traded up. It's still up almost 80% compared to offer price.
All right. Is there anything else in the pipeline, though? I mean, that could come soon, or are we just going to have to wait and see?
There are a couple of things that people are expecting. You know, there are company in the tech space that had always been rumored to be IPO'd, such as the Instacart, the GoPuff. All these companies will be a little bit more sensitive to market sentiment compared to a consumer product company like a Birkenstock.
All right. Crystal C covers the IPO market for us, and maybe potentially we get an IPO for Birkenstocks, and maybe we get potentially a little bit of pickup in IPO activity as we get deeper into the year. Meanwhile, of course, we know that the macro has been driving things, and we did get a big jobs report today. That June jobs report showed U.S. employers added fewer jobs than projected. Remember, every month we've been getting these upside surprises. Not anymore. It does illustrate a labor market that is gradually cooling, but a labor market that, at least by some measures, is still resilient. Jared Bernstein joining us right now. He is the chair of the U.S. Council of Economic Advisors out there on the lawn of the White House. And Jared, let's start off here. 209,000 jobs created in the month of June. Let's just be clear. I mean, pre-pandemic, I think most of us would have taken 209,000 jobs, but given the high base of which we're coming off from, there is some concern here about whether we're cooling a little bit too much.
Well, I think some cooling is important and expected, and you're absolutely right. 209,000 jobs is a solid number at this point in the expansion. One of the things we did today on our CEA blog is to look at precisely that. What would you expect at this point in an economic expansion about 38 months in? And we compared it to prior expansions. We looked at where unemployment is and job gains have been traditionally with that relationship. And we come up with numbers in the sort of 160, 170,000 range. So we are continuing to outperform as the economy, as the labor market necessarily cools to better align labor supply and demand.
I am curious as to whether there is concern here from an economist perspective, and whatever discussions you have to have with the president and the rest of his team here, that what the Fed has done so far and what it may continue doing could provide additional weakness, I should say, to certain areas of the economy that could maybe mean that we're not talking about 209,000 jobs in the next report or the report after that. We could be talking about something a lot smaller.
Well, let me tell you that, as you well know, and I think your intro suggested this, for something like 14 or 15 months in a row, the jobs report beat expectations. So the fact that this is one month where it underperformed expectations by a little bit shouldn't lead us to completely rewrite recent history. Look, as you well know, we don't get into the Fed's knitting, and one of the most important things we can do to help ease inflationary pressures, I should say to help continue to ease inflationary pressures, because inflation is down by more than half since its peak, is to let the Fed do its thing. Now, when I listen to Chair Powell talk about the macroeconomy, and certainly from our perspective, when we talk about transitioning to steady, stable growth, the kind of things we're looking for is a deceleration from the breakneck pace of job gains, but still significant additions. And that's exactly what we saw in June. You know, we have an unemployment rate that's been below 4% for 17 months. That's a 50-year record. So we still have a strong job market, but we're making important progress on easing inflationary pressures.
There are a lot of people, though, looking at this report, too, Jared, and they're looking at other measures like the payroll diffusion indexes and saying that maybe the job growth that we have is a little bit more concentrated in certain sectors. So, yes, we're creating those jobs. Those jobs are at a level in aggregate that are healthy, but this is not necessarily a broad-based expansion of the labor market right now.
Well, we really like to get under the hood, and in fact, I'm glad you brought up the diffusion index, because I think that's an important indicator that's a bit underloved. But of course, that's been north of 50% for a while now, and one reason for that is that at least over the course of the expansion, the manufacturing sector has been pretty strong, up just under 800,000 jobs. That's still a very strong expansion. Now, in recent months, that's settled down some, and we'll continue to watch that. Autos have started to perk up a bit. We've seen some good results on auto sales, on auto production. So we're actually seeing good construction results, by the way, including today. Yeah. So I think if we look sector by sector, we still see a thoroughly robust job market.
Well, what about some of the demographics? Our international economics correspondent Michael McKee pointed this out to me, that when you look at the unemployment rates in terms of demographics here, went down for white men, went down for white women, but it went up for blacks, it went up for Hispanics, and it went up for those who only have a high school education or less.
Well, if you look at some of those demographic categories, as you should, and I applaud Michael for doing that, you really do have to take account of the fact that these are some very noisy indicators. They jump around a lot from month to month, and in fact, the increase in black unemployment, BLS will tell you that was statistically insignificant in June, but that wasn't the case in May, where it did grow. But that's off a 4.7% trough. That's, I think, among the lowest black unemployment rate on record. So the smart thing there to do is to take the average for the quarter. The black unemployment rate for Q2 is 5.4%. Okay, right. Because we got June this morning. That's tied for the lowest quarterly rate on record.
Okay, but it's still almost double what you find for whites, and there are certain...
Well, that is a very long-term structural problem and something we care a lot about. And in fact, one of the pillars of Bidenomics is trying to make sure that our public investments and our empowering of the workforce reaches folks from all communities, not just those on the coast, not just those in rural areas, but communities of color. That's a very important value of ours.
How are you doing that right now? And more importantly, Jared, how do you communicate that to folks who aren't economists, who don't understand all the sort of machinations that go into these reports?
Great question. So one of the best ways I think we're doing that is if you look at the scope and space of the investments associated with Bidenomics, and of course I'm talking about the Inflation Reduction Act, the CHIPS and Science Act, and the Bipartisan Infrastructure Law. Go to invest.gov. So this is not just hand-waving. This is data that you can click to in one click. And I know you at Bloomberg are very good at these graphics, so I suggest you go there and show your viewers this, and you will see these little bubbles of investment all across the country. And your question about how do we get the message out? Well, invest.gov is one way to do it, but another very powerful way to do that is to have our team, from the president down to the cabinet, getting out there, flooding the nation, explaining to them what we do. And then the president was in South Carolina just the other day talking precisely about these investments, and I think that's a good way to break through on that important geographical dispersion of these investments.
All right, Jared, we're going to have to leave it there. Appreciate you rushing over and taking time for us. Jared Bernstein there, the chair of the White House Council of Economic Advisors. A look at a very complex jobs report that we got earlier this morning. Still ahead, a discussion coming up here about, well, artificial intelligence. And when it comes to artificial intelligence, the world needs a second source to NVIDIA. That's why Northland upgraded AMD. We're going to talk to the analyst behind that call. That's coming up after the break. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders. Fenway Sports Group has become a $10 billion global powerhouse. CFO Julie Swinehart tells Tom Keene how she's helping the company raise its game.
Winning's at the core of everything we do here, and the balance sheet is so important to the success of the team.
Watch Chief Future Officer, Wednesday on Bloomberg.
DOJ or other authorities
could face bigger challenges.
Was next.
Fed was going to keep rates.
World Cup. This is a 3
as the economic picture does.
The OK is getting ready to make a decision.
Most of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we've seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
July 11th, Bloomberg is live in Lithuania for the NATO Leaders Summit. Support for Ukraine, expanding partnerships, broad security challenges. We're bringing you news from the meetings and what they mean for the markets.
At the summit, we'll actually make important decisions to address our two main threats, Russia's aggressive actions and our efforts to fight terrorism.
It all starts July 11th. Bloomberg, your global business authority.
All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we're going to start off with Warner Brothers Discovery here. Downgraded to peer perform over at Wolfe Research. The reason? An imminent downturn in TV advertising. Analyst Peter Supino saying that the stock's performance all depends on executives meeting those near-term guidance. Well, that could prove a bit too challenging with linear TV ads under pressure. Warner Brothers Discovery shares relatively unchanged on the day. Next up, let's take a look at Williams-Sonoma. Getting cut today to underweight over at Barclays. The price target getting chipped down to 115 from 126. And the analyst saying that risk to same-store sales still there despite a more stable macro environment. And he says that this is largely due to weaker consumer demand. Shares of Williams-Sonoma down only about 1% on the day. But let's take a look at Rivian right now. Dan Ives over at Wedbush joining the chorus of bulls out there, raising his price target to 30 from 25, saying the EV maker, quote, finally making a major turn towards those longer-term goals. Production supply chain issues well under control, according to Ives. Rivian began, of course, rolling out its first shipment of Amazon delivery vans to Europe this week. Those shares right now on an 8-day run. That includes a 14% gain today and almost a 90% gain over that 8-day stretch. And those are some of our top calls. We want to stay, of course, in the sell side space here and pivot to semiconductors and AI. Here's the quote. The only thing worse than being wrong is not admitting it, and we have been wrong about AMD. That's what Northland Capital Markets said in a note earlier this week, upgrading the chip maker to outperform. The analyst joining me right now, Gus Richard, telling investors that AMD has the suite to handle AI and can be a key source for the tools besides NVIDIA. Gus is a senior research analyst and managing director at Northland, and he joins me right now. And Gus, let's start here. I mean, because we know that NVIDIA is kind of the stock of the year so far. AMD, a relative laggard, though I think it's still up like 70% here. What's the attractiveness for AMD in this space?
Well, fundamentally, there's only two companies that have GPUs that are used for AI dominantly today.